Okay, good morning, everyone, and welcome to the March 12th, 2025 CalSTRS Investment Committee meeting. Take the roll, please.
Certainly. For the Director of Finance, Ms. Whitaker.
Present.
For the State Controller, Ms. Gallegos.
Here.
Mr. Tang.
Here.
Ms. Yamamoto.
Here.
Ms. Bradford.
Here.
Hendricks.
Here.
Mr. Gunning.
Here.
For the State Treasurer, Mr. Rufino.
Present.
The Superintendent of Public Instruction, Mr. Garfinkel.
Here.
Mr. Juarez.
Here.
Chair Keeley, you have a quorum.
Thanks very much. So a couple of comments before we begin. We're going to read, first we're going to read into the minutes the
Thank you.
statement. Thank you.
The CalSTRS board meetings are live, web streamed, video archived, and available to the public on calstrs.com. Individuals who wish to address the board should wait for the 10-minute public comment period at the end of the agenda item that the speaker wishes to address. For comments not pertaining to specific agenda item, there will be an opportunity for additional statements at the beginning, end of the open session. Each speaker is allowed a maximum of 3 minutes to comment. However, if there's not enough time for each speaker to have 3 minutes, the timing will be at the discretion of the chair. To protect the privacy of speakers under the age of 18 who wish to address the board, only their first name and affiliated organization may be provided, but other personal identifying information such as their last name, age, or school may not be shared. Since the January Teachers Retirement Board meeting, CalSTRS received 38 emails from members and non-members requesting CalSTRS to divest from Tesla, 1 email from a member requesting CalSTRS divest from Tesla, Meta, and Amazon, 1 email from a member requesting CalSTRS divest from all ventures associated with Elon Musk, 3 emails from members requesting to divest from East African crude oil pipeline, 312 form emails from members and non-members requesting to divest from fossil fuel companies due to the Los Angeles fires, and 1 email from a member who is requesting to divest from all fossil fuel companies, the military industrial complex, and all companies operating in Israel. Back to you, Chair.
Thank you very much. And entertain a motion to approve today's agenda with some flexibility.
So moved.
Second.
It's been moved by Mr. Tang, seconded by Ms. Yamamoto. Any objection? Without objection, the agenda has been approved with some flexibility. Thank you very much. Before we go to our video, just a couple of comments. The next couple of days, we have a lot of work to do. We just highlight 3 areas that we will be focused on today and tomorrow as an investment committee. These semi-annual reports we'll be receiving from our 3 investment committee consultants, both in open session and in closed session. And I'd like to remind everybody on the committee that staff and the leadership of the committee have recognized that there might be some additional comments and discussion in closed session around specific investments and/or partnerships. And we will allot as much time as needed in closed session so that some of the comments about specific investments do not make their way into open session where they would be inappropriate for those to be discussed. Tomorrow we'll be doing the interviews of the 2 finalists for our general consultants. We're asking everybody on the committee to be there. And that will be tomorrow, and we anticipate by the end of the day tomorrow we'll have made a selection, and pending the negotiations with the selected firm, we'll have identified the consultant to support the committee. We have a couple of policy items today, one in particularly RMS, and of course we'll be hearing from our CIO, Scott Chan. Obviously there's a lot going on, but we have a great way of beginning each one of our investment committee meetings and board meetings with a reminder of why CalSTRS exists. And so we'll go right to that video. Thanks, Jonathan.
You can go back with skinny markers that I'll give you later on and like highlight maybe on.
My name is Amelia Cunha. I am a 5th grade teacher at Howe Avenue Elementary.
I've been teaching for 3 years. My father was a special education teacher when I was very little in LA County, and then as I got older and met my husband, my mother-in-law was a veteran teacher in the San Juan School District, and I started working a lot in her classroom, and I just fell in love with it. I was not what you would call the perfect student. I had a very chaotic home life growing up. We were extremely poor. And so I actually failed out of high school due to being homeless. But when I went back to college, I gained this sense of confidence because I started acing every class and graduating with honors. And I realized that it was not an intelligence thing. It was a lack of support, things outside of my control, poverty. That really inspired the work that I do in my class, so teaching the whole kid and also teaching them life skills. You guys are one day going to be adults. How will you give back? How will you make change? And so that has blossomed into different things. So that has blossomed into a leadership group called the How Helpers. We make bags each year for the local in-house community. And then in my classroom and in my teaching, it includes using different lenses through teaching. Not every kid is going to be a mathematician. Some kids are artists. The importance of including art in your education is that it teaches me so many things about my kids that they could never tell me. Our curriculum was teaching about hydroponics this year, and I thought it would be a really cool way to bring that to life for the students here, that they could not only read about hydroponics on the page, but they could physically see it. And so I applied for a grant, a Donors Choose grant for my classroom.
We use a UV light and some water, and there's a sponge. These are all like these are all lettuce, and this is like bell peppers, since it's small. This one's mine, and it's a bell pepper.
I've thought about retirement a lot. It was one of the other added benefits that drew me into teaching. Having a CalSTRS benefit means that I don't have to be concerned about my future. My husband and I are really concerned with having a nice retirement for both of us. One of the things that we often talk about is eventually when we retire, working in the national parks. As rangers, we both really love nature. We're constantly keeping that in mind in the financial decisions that we make.
But I will help you with your grammar. I threw my arms around her.
This year we've been ending the very end right before we leave, usually with a gratitude list. So 3 things they're grateful for. And so they leave knowing that they're loved and happy and calm and regulated.
Thank you to our communications staff. Another great video. And I am reminded of what an honor and privilege it is to serve in this role, all of us, to protect and preserve the retirement security of California's educators. Whatever role we're in here at CalSTRS, either directly working at CalSTRS or any of our business partners, it is an honor and a privilege to protect and preserve the retirement security of California's educators. We love educators, we love public education, and we love what we get to do on behalf of those great teachers. So it is really an honor and a privilege, and this video reminds us of why we're here. And I'm super proud of all the work that we do. So with that, we're going to hear from, I think, public comments. And during public comments, we will receive your public comments, but we will not engage in a dialogue of questions and answers with you. So if we could have the speakers be identified, we'll hear from our public now.
Okay, our first speaker, we will take in person first, and then we will take phone. Our first speaker will be Jared.
to Tony's Workers says UFCW has previously agreed to member firings over immigration-related matters. Given the backdrop of high-profile immigration raids in Chicago, Heritage's attempt to make Tony's Workers think UFCW is an agent of immigration-related firings is outrageous and disingenuous. It heightens fear in immigrant communities where both employees and customers of Tony's stores live. We can share copies of some of the messages with you and your staff after I speak. Heritage also appears to be employing a union-busting consultant called People Results to help run the anti-union campaign, a questionable use of your money as investors. We believe that this anti-union campaign from Heritage is not only wrong, but also violates Apollo's own workforce principles on, quote, respecting the rights of employees to decide whether or not to join a union and engage in organizing efforts, end quote. We previously told you that Heritage's anti-union behavior at Cardenas led to a complaint filed by the National Labor Relations Board on October 30th, 2024, against Cardenas, alleging the respondent has been interfering with, restraining, and coercing employees in the exercise of their rights to freely choose whether or not to form a union. Additionally, we have recently learned of 2 new class action lawsuits filed in 2024 against Cardenas, alleging violations of California Labor Code regarding overtime, meal break, and rest break violations. One was filed in Los Angeles County, one in Santa Clara County, and Cardenas is seeking to compel the Santa Clara case to arbitration. These class action lawsuits come after two class actions alleging violations of California Labor Code that were settled at a cost of $4 million, settlements where Cardenas did not admit wrongdoing. We have also learned that there are now 3 women suing Cardenas for alleged sexual harassment and retaliation for reporting sexual harassment. You have previously heard from one of these workers. Heritage's anti-union campaign runs counter to CalSTRS risk factors, including workers' rights, like specifically the right of association, the right to organize and bargain collectively. Litigation alleging sexual harassment at Heritage raises risks under the risk factor titled discrimination based on sex. Apollo is or will be seeking commitments from CalSTRS for its new fund, Apollo Fund 11. We urge CalSTRS to hold Apollo accountable for violating your risk factors and investment principles at Heritage before considering a new allocation of funds for Apollo management. Thank you.
Thank you for your comment. Our next speaker will be Edward.
My name's Edward Hasbrook, and I'm the spouse of a teacher, beneficiary of a CalSTRS pension, one of those to whom you have a fiduciary responsibility. I hope you will exercise that fiduciary responsibility to sell all of your highly risky, bad investment declining rapidly in Tesla. These are difficult times that call for more than ordinary actions. In the face of a fascist coup in which the president has arrogated to himself the powers of a dictator and has purported to delegate that power to an unelected crackpot who is taking a chainsaw to our democracy, our freedom, the infrastructure of government services, and not least to public education. People around the world are asking themselves, what can I do to turn this around? You, however, are in a position to do something. We're at an inflection point. You have a choice to make. If you've already made it and have sold off Tesla already, thank you. We congratulate you. But you have a choice. We're early. Some of you may remember the South African divestment campaign that went on, building over a period of years before we were able to celebrate majority rule in South Africa. You can do nothing now, hold on to Tesla. We'll be back, more of us, to your next meeting, still asking you to sell Tesla, which will be worth less then, or you can do the right thing. You have ample fiscal reasons to sell that Tesla stock, but in selling it, you will be doing more than fulfilling your fiduciary responsibility. You'll also be doing the right thing, something billions of people around the world would like to be able to do, making a concrete step that will empower and encourage other fund managers similarly to drop Tesla. You know, I hope, I believe that you all have some of that human empathy which Elon Musk so transparently lacks. I hope and I believe that you want to do the right thing, that you share in the desire to take a step to start to roll back this coup, to restore our democracy. I implore you, you have the ability to do the right thing so that we can come back to your next meeting to celebrate and congratulate you. Please be the heroes that you want to be. Sell Tesla, all of it, now. Thank you.
Thank you for your comment. Our next speaker will be Ruth.
Good morning. My name is Ruth Rudetsky. I'm a retired San Francisco Unified math teacher. I'm here to ask you to divest completely from Tesla. I was horrified to find out that CalSTRS had more than $1 billion invested in Tesla. Maybe $1 billion isn't that much with respect to the whole CalSTRS portfolio, but you know what they say, $1 billion here, $1 billion there, and pretty soon you're talking about real money. There are compelling financial arguments to divest. An absent CEO, technology that is years behind promised delivery dates, but mostly I don't want my financial safety tied to the financial safety of Elon Musk, a man who is delighting in destroying the country I love, the country he thinks he bought, just like he bought and destroyed Twitter, while dog whistling to neo-Nazis and white supremacists. Maybe you're already divesting and just haven't announced it yet. If that's the case, thank you, and please hurry up and finish and announce it so the world knows California teachers' values. My grandfather was an educator in Germany before World War II. He would not have been with me here today if he were alive, because he loved his country and wouldn't have criticized it publicly. He was a good German. Germans keep good records. The current principal of his school showed me the minutes of the faculty meeting where it was announced that he was fired for being Jewish. I like to think I've learned from my grandfather's life. I'm here today urging you to divest from Tesla because I love my country. Selling Tesla is the financially prudent thing to do. Chaotic leadership is bad for investments and countries. But more importantly, hurting Musk and slowing the headlong rush to fascism in America is the right thing to do. My father, too, was an educator. Today would have been his 92nd birthday, and were he still alive, he'd be right here with me today. Happy birthday, Dad. Thank you.
Thank you for your comment. We'll now move to the phone. Our speaker will be Danisha. Danisha, go ahead.
Hi, I'm Danisha Lugo, a current professor at a California community college. I agree with the emails read previously today, as well as the in-person statement. I support and request divesting our retirement monies from Tesla, Meta, and any other businesses that do not support the values and vision of the California educational system. How do we teach our students to be critical thinkers and make informed decisions when our retirement investments support companies that devalue the very things we teach? We have millions of our retirement monies invested in companies that do not care about us or the students we serve. Please divest from Tesla, Meta, and other investments identified by other members for moral and financial reasons. We should not have to worry about our retirement being available based on the actions of people that wish to line their pockets even more. And I'm in agreement with the previous speakers. If you have already decided to divest, we thank you. And if not, we will be back. Thank you for allowing me to speak.
Thank you for your comment. That is the conclusion for item 2.
Thank you, Samantha. Thank you to the members of the public for taking time and expressing your views this morning. Go right to item 3, which is our CIO, Chief Investment Officer's report. And just in terms of process throughout the morning and this afternoon, We'll hear from our presenters, and we'll take questions and comments after their presentations rather than throughout the presentation. Scott?
Good morning, members of the Investment Committee. My CIO report today has two components, broadly speaking. Number one, and it's usually we're looking backwards in the calendar year performance today, and it's, I don't want to call it boring, but it's typical. Today is not typical. I'm going to spend a lot of time, a bulk of our time, looking forward into the uncertainty, the risk, and the market environment. The second thing I want to do is talk about our private markets priorities work plan. So those are the two components. So let me just start with the risk, the uncertainty in the markets. In the first several months, President Trump has issued more executive orders, an astounding amount of executive orders, than any other president in the same time frame. These executive orders and additional policies have caused a tremendous amount of uncertainty in the marketplace. And as you know, markets and corporations, they don't like uncertainty. But this is going beyond that typical market uncertainty that corporations don't like. I would say that the potential risks here are unprecedented. They're world changing. I was thinking about an analogy I could tell Steve, but I couldn't think of it. I just came up with the words unprecedented and world changing. Because of the uniquely uncertain and risky environment we're in, again, I'm going to spend the bulk of the time answering two big questions that I'm sure are on your mind. They've been on my mind. The first one is why I believe that the risk and probability of recession and even potentially a short bout of stagflation has increased significantly. And number two, how are we navigating this environment? How are we navigating the portfolio? So let me just start with why risks are elevated and the probability of recession and the potential for stagflation has increased. We entered the year, 2024, the economy was fairly strong. We entered 2025 with that strong economy, good GDP growth, strong earnings, low unemployment, inflation had been moderating, interest rates, while higher, also were beginning to moderate. I think, it's broadly considered a strong future for the US if you think about technology, AI, our energy dependence and moving to path net zero. There are a lot of strong components. Fast forward today, the stock market is negative on the year. The NASDAQ is in correction territory. The S&P 500 is near it. That's a 10% correction or more. Consumer confidence is falling. ISM's pointing down. Business transactions are slowing due to the uncertainty. So what's changed to the negative is fairly unique because it's almost entirely related to policy, and that's unique. We haven't seen that in many circumstances. There's too many to cover, so I thought for the sake of brevity, I would cover just the top four for me. Number one is tariffs and the potentials for a trade war. So there are a lot of outcomes possible here, from a benign scenario that, hey, we're just negotiating and perhaps it's a one-time hit to the economy. Maybe we get a bit of inflation, a little bit slower growth, to the potential for a trade war, which then I think you put on the real risk of a recession and even the potential for stagflation. And I think that risk has been the biggest change, that we have to accept the possibility of that risk as we are engaging and deepening into this and potentially heading into a trade war, which would have very, very severe consequences to investment portfolios, not just ours. The second risk that I would address is the Ukraine and Russia conflict. I think it's safe to say that we all hope for peace. We all want this to happen. The world is watching the terms, the potential deal that the US is helping to negotiate. But to me, the most important factor isn't who's getting more, Ukraine, Russia, US. It's the potential that the US does not help to secure the Ukraine. The strategy that the US is withdrawing from these endeavors of freedom in the world. And that, to me, it puts into question our role in NATO, and it may ultimately embolden more from, from China, from Russia, from Venezuela, et cetera, globally. Those are geopolitical types of risks that would be extremely hard to navigate, from a portfolio perspective. Number three to me is the larger deficit that we continue to expect. We're expecting extension of the tax cuts, so that could be good in the short term, relative to the economy, but it's likely to add and increase to the deficit among a whole host of other things that might add to that. And structurally, I think that means higher interest rates over a long-term period with the possibility of some issues around the supply and demand of treasuries, right? But with over 36 trillion in debt, which is over 7% of our GDP, this has to go down structurally. We're simply spending too much, and it's unsustainable. We're like akin to a train heading off of a cliff. I don't know when the risk will materialize, but there is significant risk, with that situation. Fourth would be immigration. I think that I've looked at, it's surprising that this would be number four, but I've looked at different estimates and I've come up with kind of base cases where maybe that shaves off 0.5% or a percentage point of GDP. We could go into more risks because I think we've covered them in past meetings. Those risks continue to exist, and so these are just additional uncertainty and risks that we're dealing with. I'd say one piece of good news is the Fed has a lot of firepower. But I think that the bad news is that we entered the year with an economy that maybe was a little hotter than expected. And so I think that for the Fed to act, it's my opinion that we're going to have to see substantial deflation and maybe substantial GDP negative growth in order for them to want to act. And that period of being on hold, we could see the markets down, again, 20%, maybe even 30%. I said that this year could be the year where we see that because of all the uncertainty. And we have been working as a team, and the board has approved many things for us to enhance our liquidity tools. And we kind of hurried up, but we didn't use them. We've been reserving that. Again, this could be the year where we actually utilize a lot of the tools that we worked on together and the board approved, which is going to give us more flexibility to navigate this environment. So I'm going to stop there on the environment. I'm going to move into now how are we navigating this environment. And I'm going to spend a lot of time here because I want everyone to understand, how exactly we're doing that. Because I think first and foremost, I'm relying on, and you're relying on, the expert knowledge and judgment of your staff. We have 258 investment professionals here. We have, in my opinion, some of the world's best consultants you see in front of you. We have some of the world's best partners, which we leverage, some of the leading asset managers in the world. But I also want to talk about how we have been positioning the portfolio across four areas. Number one would be our strategic asset allocation. Number two, an annual asset allocation plan where we're dynamically positioning the portfolio over periods of 1 to 3 years, per se. Our tactical positioning and management of our risks in our risk allocation committee. And then for generally how we're managing and mitigating risks. And so if you think about it, many of these processes have been around for a long time. And we've been successfully relying on multiple tools and processes to help us navigate recessions and shocks in the markets in the past. So I'm drawing that analogy of our history. In my opinion, this serves as a great foundation. But the good news is we've continued to build and enhance our tools and processes in every step of the way. And so the investment committee has had a significant role in this. And so thanks to you, I'm going to be spending some time talking about how, as we enter this period, even with a more robust set of tools and processes around liquidity and so forth. So starting at number one, our strategic asset allocation, which we do in combination with analyzing our liabilities every 4 years. This is the main driver of return. I think you all have heard us talk about this in the past. the key components, the pillars are diversification and our discipline to rebalance the portfolio, even in market turbulence. And so we continue to implement the strategic asset allocation, which is diversified across assets, sectors, companies, geographies, and risk factors. Diversification is the key to achieve our objectives because we won't know, nobody will know precisely the macroeconomic environment or regime, what crisis we may or may not find ourselves. But we've built a portfolio that over the long term, and I'm going to emphasize the words long term, it's the best way for us to achieve our financial goals. Implementing our diversified strategic asset allocation and demonstrating that discipline and rebalancing when markets are down gives us the best chance to fulfill our mission to the California educators. In any given short-term time frame, that may be difficult. Why? Because we have a 7% target, we need to be positioned towards growth in the portfolio, our growth part of the portfolio, like private equity, global equity. The markets had their, if we have a recession, the markets head down in a short period of time, our portfolio will be down too. It will be down less than the markets. It has been in the past because of our diversification, but it will be down. So before I get too bearish, let me just say that the markets also could be up 20%, just as well as they could be down 20%. No one has a perfect crystal ball. And in most years, to make our return in the stock market, think of it this way, eight days in the stock market. If you're invested in those 8 days, you've made your return. If you're not, you're out. And so you have to be invested. You have to maintain, if you think about those realities. And for all these reasons, we need to stay the course. But I also want to then talk about some other things because we have our strategic asset allocation. Executing that is a dynamic exercise, implementing it, because as assets shift constantly, as risk also shifts, your staff, your consultants, we position the portfolio. And so I'm going to talk about two processes in particular that we use to be more dynamic around the strategic asset allocation. One of them is our annual asset allocation process. And you can think about this as we're positioning the assets at a midterm basis, maybe 1 to 3 years. One of the first major decisions I made as the CIO here, the new CIO here, was to create a total fund management division. I promoted June Kim as the senior investment director to oversee that with the hope that a centralized unit could facilitate the expertise of all of our divisions, all of the input, the power of being able to shift the assets on an underweight or an overweight basis amongst our different asset classes, utilizing the input of all the divisions, and to add hopefully another layer of risk management and another layer of alpha. This comes together in what we call internally the 2025 annual asset allocation plan and priorities. And I want to just give you 3 points. This is, by the way, the second year that we've executed this. And the purpose is to be more dynamic around the strategic asset allocation and be able to mitigate and manage risk better, be able to think about opportunities better. So I'm going to make 3 points of how we thought about the 2025 year. The first point is we're moving our diversifying portfolio to target. So we had been underweight, and that had benefited us during a bull market phase. But we decided to move that to target. And by diversifying, you can think of it as being more defensive. So these are areas like fixed income, RMS, cash. They do better when markets are down. And so obviously due to the uncertainty environment, this was a driver for us to allocate in that direction. Point number 2 is to reserve liquidity. We may not know when a crisis happens. We may not know the trigger of it. But we do know that when that happens, having liquidity, cash, is like better than gold, right? Because we need to then use that liquidity to maneuver the portfolio. Some of the best opportunities ever in my career, they've happened during crises when asset prices are at their lows. We also need it to mitigate risk in the portfolio, to rebalance it, right? And so big point number 2 is we're reserving a lot of liquidity for the volatile markets ahead to maneuver. Point number 3, we're accelerating the planned diversification from global equities into some of the private markets that give us a bit more diversification. In a crisis, everything turns out to be correlated, but I think over time, over the long term, they tend to diversify our asset base. And so with the run up in global equities over the past couple of years, 20% plus returns in the S&P over the decade, and these numbers are probably stale because the market's heading down, but we had been somewhere in the range of 13% a year. Valuations had become rich. And if you looked forward, even at the start of this year, before the markets went down, you would say, I think global equities may return me 7%, maybe less. And all these other elements that we had thought as better opportunities as part of our annual process, infrastructure, the energy transition, private credit on the asset backside. Even as we think about the inflection point of real estate, we're not calling for an inflection point, but these are opportunities that most likely are not only going to diversify the portfolio, but outperform. So this has been an evolving process, and I think you've heard the buzz term in the industry. What's your total portfolio approach, or TPA? You could say this is CalSTRS' version of that and how we pull it together. The third element I want to talk about is RAC, our Risk Allocation Committee. And to step back, this is a committee where we do tactical and risk positioning. We think about the liquidity and cash of the portfolio, and we rebalance the portfolio through the public markets. And so this is run by June Kim, the Senior Investment Director of Total Fund Management. It used to be run by Geraldine before she was promoted into the public markets. We have all of our public market directors as voting members. I'm there. Our investment services director is there. The private markets show up as observers. We meet formally 2 times a month or as needed. And we've been meeting a lot more in this recent environment because it has been, quote unquote, as needed. What we decided to do, broadly speaking, in that committee is accelerate a lot of the changes, moving, diversifying forward. And so in this period, we've been purchasing a lot of fixed income in our diversifying bucket. We've accelerated the move out of global equities, neutralizing our growth position. If you think about the growth position being private equity and global equities together. And we've been raising the bar on our private markets transactions, because in a riskier environment, you should necessitate either a higher return or more safety, less risky. And that has naturally slowed transactions. But that's not, we're not going out on a limb. Transactions are slowing in the industry. You always want to be able to seek opportunities, because by virtue of transactions slowing, people not willing to invest, that's an opportunity in and of itself, right? But we're being very selective. So let me just end with, if I look back in history, in every crisis, I think we as an organization have gotten stronger through that. And so today we enter the period with a lot of those strengths. Through the 2008 crisis, RMS, that division, Risk Mitigating Strategies, was born. Through COVID, we were utilizing futures and derivatives to rebalance a portfolio to mitigate risk. That saved us, $2 billion in that short time frame. We've enhanced the liquidity tools, the annual asset allocation process I talked about, the policy on leverage, widening the allocation bands. And we've always had the Risk Allocation Committee. So I just wanted to give you a sense of the processes, the positioning of the portfolio, and how we've been navigating it. But beyond all these tools, again, you rely on an expert team. You rely on your expert consultants and all of our partners who we leverage. I mean, think about it this way. When I was talking about the conflicts in Ukraine and Middle East, I talked with Admiral Stavridis. He used to be the Supreme Commander of NATO. We talked to Eurasia, right? So we have so much intelligence and partners to help us navigate these markets. But at the same point, today's storm is different. The uniqueness of the crisis is really defining, I think, or not the crisis, but in a crisis, I think what's unique about it are several things. Is that we don't know what the shock is. That's unpredictable. The trigger's different every time. In 2008, it was the mortgage crisis. In 2019, it was a virus. The depth of the crisis is unpredictable. We don't know the follow effects of the stress, for example. In 2008, it was too big to fail and systematic. In 2019, corporations just didn't have the cash flow to survive over a 3-month period. So every crisis, also there's born a set of fantastic opportunities. Out of the 2008 crisis, you might say, private credit was born as one of the larger opportunity sets. But we've developed tools and expertise to weather these storms, mitigate risk, and identify the best opportunities. And so I want to end with that. And I spent more time than usual, but I think it matches the time period we're in. And so with that, I'd like to take questions before moving to the second component and talking about private markets priorities.
Thanks very much, Scott. Mr. Juarez.
Yeah, thank you for that, Scott. I really appreciate sort of the approach you and your staff have taken in terms of methodically letting us know why we're well positioned, even if we're going to say, heaven forbid, we're going to lose money, let's say, but we're going to lose less because we've been able to take defensive positions, we've kept more in cash, we've taken care of some of the private opportunities that you mentioned. And I bring this all to bear because I know I'm going to be asked about this when I go for my confirmation hearing. And I feel very comfortable in sharing with the Senate Rules Committee that we are in a good position. We're as good position as we can be given the uncertainties in the marketplace. And I just want to thank you for that. I mean, I think I'm well prepared to testify to that impact and to that effect. So again, I appreciate all that you've shared with us. I've scribbled a lot of notes that I'll be regurgitating, if you will, to the Senate Rules Committee when my time is up. So I appreciate that.
Thank you, Mr. Juarez. Any other questions for Scott? Seeing none, Scott, I too just want to thank you for your communications with the committee prior to the meeting, as well as your comments early just now. I think you give us the appropriate visibility and insight as to how the team is positioning the portfolio. Thank you, sir.
Thank you. And we'll talk more about this in closed session, where I'm sure there'll be a lot more questions that are specific to our transactions and specific assets. Let me move now to the second component of the CIO report, which is an update on our private markets priorities work plan. You'll recall that we talked about this in the last January committee meeting, and we got a broad approval to go forward. And so we're bringing back a plan. I wanted to brief you on that. It really addresses the 4 pillars we talked about of this work plan. Number 1 is education around the private markets and the way we do due diligence, for example, our beliefs and policies which govern all of what we do, the roles and responsibilities, not only of the investment committee and staff, but our consultants and others, and the processes that go around that. And so I just wanted to go through the calendar here in this nice chart that education actually starts today in March. In the semi-annual performance reports that are presented by the consultants, they will go through, why we are investing in private markets broadly, as well as the due diligence we do and the ongoing engagement we have with private markets partners of ours. If we head to May, we think that something that's very foundational is education on the fiduciary duty and investment risk around our private markets and engagement. So that's going to be led by our Chief Counsel, Brian Bartow, and with the perspective of our independent fiduciary counsel as well. If we head to September, we're going to staff will provide an overview of CalSTRS' investment beliefs and policies. But staff will also give you a review and an overview of what our peers are doing. So you get a sense holistically of what's going on, not only with what we do, but with what our global partners do. And we're going to review how we engage with our private market partners. and we'll talk about potential follow-ups, because as we head into November, we'll bring back potential recommendations for policy revisions and potentially things like a new investment belief if warranted. And we'll also think about and review the roles and responsibilities and make recommendations there appropriately across our CalSTRS ecosystem. So we held short in diagramming out the year after that, because I think it really depends on the recommendations and what the investment committee wants the direction to go forward. But once we have clarity on that, we'll then develop a list of follow-up for that. So that being said, I want to see if there are any questions here on the private markets priorities work plan.
Ms. Hendricks. Sure.
Yes, thanks, Mr. Chair. Thanks, Scott. I love timelines. I love seeing kind of where we're headed and kind of what are the touch points along the way. I think one of the questions that's come up for me, because I support this process that we're in terms of educating the board, and I'm glad that we're hearing, from council and from our fiduciary council. In the meantime, between now and eventually, if we decide to adopt an investment belief or modify policy, what assurances as a board member can you give us around some of the labor issues that we do hear about and the potential risk in the private markets currently if we don't have kind of those modifications to the policy completed yet? And so what sort of, I guess, covers us in the meantime as we're in this process in terms of, or what protects us for some of the risks, including labor risks, that we've experienced for years now, but I think we're trying to address it with this, this plan that we have moving forward. But maybe talk a little bit about where we're at now, and then eventually where we'll hopefully finish up, and sort of how are we mitigating the labor risk currently in the private markets specifically?
Yeah, this if I could just give a personal anecdote, it feels like something that I experienced with rolling out this shared vision and ownership with staff, because they asked me, well, what is it that we're doing wrong today? And my answer is we're absolutely doing nothing wrong today. We're leaders today. And I think in this area, if you were to poll our peers and even if you were to dialogue with our partners, we are leaders in this space. We have very defined beliefs and policies, which I think cover the gamut. Now, I think we always want to be open to best practices and how we can adapt to the future. But I would say today, I feel very confident that we're mitigating the risks as best as we can. And oftentimes we're taking that up into closed session because they're very specific transactions that we unpack. And I think I hope the committee feels comfortable with the actions we take on a case-by-case basis even, but it stems from your investment beliefs and policies. Now I would say that those are fairly complex. They span different parts of our policies. So when you knit them together, it's almost as if you need a staff member to say, like, well, here's where that is and here's what, and so are there ways we can streamline that? Are there ways we can become more clear? And I think looking forward, there are some ways where we can also set the tone with potentially, for example, an investment belief that would even provide more guidance. But I can assure you today that I'm very confident that we are managing these risks very well. And I would be happy to talk about anything, regarding our specific processes in the open session, but in specific transactions in closed session.
Sure, of course. And I totally agree with that. And I recognize the balance of that, or the delicacy of the individual, companies. And I think down the road, Brian, it would be helpful, and we'll talk to our fiduciary council about this too, is I think we have these conversations in closed session, we have this process. Ultimately, whether it's through an investment belief or through policy change, it's just helpful at some point to be able to, within legal boundaries, to be able to communicate to the public and to the folks that come to these meetings or listen to these meetings or stakeholders, just to be able to, whatever we can communicate that we're modifying or changing or doing to improve and kind of bolster up the work we're doing in the private market space, I think it just brings comfort, I think, and assurance to the public. So I would look to all the professionals in this room that help guide us as a board. And I look forward to the closed session conversation later on today.
And let me know if there's anything specific that you thought, in your mind were some best practices you might want to consider accelerating. I think we should be open to that as well.
Yeah. I will.
Yep.
Sounds good. Thanks, Senator Chair.
Mr. Bartow, would you briefly just comment, because it's something we've wrestled with, and I want to just be sure that I think you were on the call with the chair and I when we discussed what's appropriate to share in open session and what's not appropriate to be shared in open session.
I think that
just in a general way.
It's generally the restriction is based upon your investment decisions. If a decision that would be made could disadvantage you in the marketplace, those are the kind of things that you can't really discuss. The other thing is, remember, we're bound by federal preemption. I think that's one of the major guardrails in what we can do because under federal law decisions, we are an arm of the state of California, and the state of California is preempted by NLRA, the National Labor Relations Act. So if there is a labor dispute, ongoing labor dispute, we have to act like the state of California and not a private investor. And I think we've briefed that issue, not just in private, but in public. So we may want to cover that again, because I think there's an expectation that we can do more than we can do, because even though we're an investor, we're considered the state of California when it comes to getting involved in ongoing labor issues. If there's an actual labor controversy regarding voting, organization, even taking a stance on encouraging labor, open discussions about labor, anything that could influence elections. So we'd be happy to cover that again. I know we did a couple of years ago, but I date everything by COVID, and it was pre-COVID, so that means it's a few years ago. So we may need to discuss that again. And the NLRB stuff we've discussed in open session, because I think the law is pretty clear on that.
Yeah, because in simple layperson's terms, as a board, I think we have an interest to disclose and a desire to disclose more to the public about how we're engaging with some of our partners. My recollection of my conversation with fiduciary counsel was, be very careful. Yeah. Those discussions need to be in closed session, and in a general high-level way, disclose what's appropriate in open session, in simple layperson's terms. Our desire may be to disclose more publicly. Council's recommendation was to be very, very cautious.
Yeah, I agree with that. I always agree with caution.
Thank you, Mr. Bartow. Anything else? Anything else, Scott?
Oh, that concludes my session unless there's any further questions.
Okay, thank you very much. Thanks, Scott. Brings us to our next item on the agenda, the shared vision RMS risk mitigating strategies. Geraldine, Stephen, Jeff.
Good morning, Senior Investment Director Geraldine Jimenez. Good to see you. We're following up from January, where we're bringing forward the shared visioning that our new CIO has brought forward. So every program will come forward with what is the goals of the program, how has it done, Are there areas of change that we should think about, and are there any policy changes? So today, we're going to talk about some policy changes that will help us bring this program into the future. And I'm going to introduce Stephen Tong, who's the Director of Risk Mitigating Strategies, and Jeffrey Jarrow, who will talk about these policy changes.
Good morning. Actually, Geraldine gave a good introduction, so I'll just pass it on to Jeff right now, and he'll go through the revisions.
Thank you, Stephen. Can I have the next slide, please? Oops. Great, thank you. How do I go back? Great, there it is. All right, so this slide summarizes the proposed policy revisions that we're presenting today. First off, at the last meeting back in January, you may recall that we discussed how the underlying RMS strategies could be classified as either defenders or diversifiers. The defenders are those strategies that are generally the most responsive during a market crisis, and the diversifiers are meant to stabilize the portfolio by providing returns when the defenders might be struggling. And so we've proposed adding these categories into the policy to be very clear about each sub-strategy's role in the portfolio. Second, we've proposed broadening the sub-strategy ranges. What we're trying to do is limit forced rebalancing. Instead, we want to be able to look at the current market environment and be very thoughtful about our positioning and our portfolio activity. And we think that broadening the strategy ranges enhances our ability to do that. Third, we've proposed restructuring the policy to align with the format that's already been approved by this committee. Our last policy update was back in 2022, and so the format needs to be modernized to put it into alignment with the other policies. Fourth, we've proposed updating or removing certain terms to improve clarity within the policy. Again, going back to the January discussion, you may recall that we talked about how RMS is not an asset class. Rather, it's a functional component of the portfolio that plays a very specific role, which is to reduce losses and protect capital at the total fund level. And so to align with that, we've proposed reframing RMS as a portfolio rather than an asset class within the policy. We've also proposed removing references to the term separate account to avoid confusion that these are the only types of investment vehicles that we can use, when in fact, we've always been able to use other types of investment vehicles as well, in addition to separate accounts. And the last point is that we think the proposed revisions will help to accommodate the continued evolution of RMS. For example, we've been working very closely with our advisor, Allborn, on determining what the next step in the evolution of RMS will look like. And that may include the addition of other defender or diversifier strategies that are not currently in the portfolio. And with that, I'll pass it back to Geraldine.
And one final point, as we evolve the portfolio, I want to remind the investment committee that we do engage Makita to do higher due diligence on RMS. So they meet with us quarterly, and we go into detail on how we're managing the portfolio. So as we evolve it, they have visibility, and then they report to the investment committee. I had one final comment on page 5 of the policy. We mentioned senior investment director delegations. After conversations with Karen Yamamoto, she had a clarification that she wasn't clear between the CIO and senior investment director. So we're recommending using senior chief investment officer everywhere to make it very clear, and that he or she may then delegate down. So that would be the only change I would say. And so maybe, Mika, if you want to make a comment.
Sure. Good morning, Mika Malone with Makita Investment Group. All I really wanted to add to the conversation is just that Makita has, as Geraldine noted, the opportunity to review RMS kind of throughout the year and speak with Stephen, Jeff, and the team around strategy updates. In this case, we had an opportunity to review fully the proposed changes to the policy, and we concur with staff's recommendations. A couple quick comments that I'll make. With respect to the addition of the terminology defenders and diversifiers, to me, this is a really helpful way to frame the context of this really important component of your portfolio in a more user-friendly format. To me, that really tells you what this portfolio is designed to do. It's to offset equity risk. And so you have defensive components and you have diversifying components of that portfolio. So I think that that is really helpful. As you flip through the policy, it looks like a lot of redlining, but a lot of that is simply to help frame that conversation in the context of that new terminology and with a few of the additional edits that Jeff mentioned. So my general feeling is these changes help bring the portfolio into the future and to remove a few very small restrictions, the range limits. I think that's an important one. You've heard some education around periods in the past where this portfolio may have breached those ranges. This just allows the portfolio not to change the way the team is managing it day to day, but to allow for the knowledge that, again, this is designed to do things in a very volatile environment. So in some cases, you may see a little bit more movement within the portfolio itself. So Makita's comfortable with these changes, but happy to take any questions too.
Sharon.
Thank you, and thank you, Mika, for your comments. That's helpful. I always like when things are more simple and clear.
Right.
That helps me in my life to understand, you know, just as an educator. So in that vein, can you just, going back to this idea of, and it's not a question of not supporting the idea, but can you talk a little bit about, you know, changing the language from asset class to portfolio? I thought I knew what a portfolio was, but maybe I don't. So can you just talk about that? Because I'm going back to the days when we were talking about the RMS strategy, because I was around when we did that. And I understand the function of RMS. Help me understand why moving it from the language, I guess, of an asset, so anyone can answer this, from an asset class to portfolio, and does that impact how we view it when we do our asset allocation study? So Geraldine, you want to start off? And
yeah, I'll start there.
Mika can supplement if needed.
That's a great point. I must admit, when I came to CalSTRS, I was surprised we called it an asset class, because in the investment world, we wouldn't consider this an asset class because it's a mixture of government treasuries and other types of strategies. So it really is more an overall portfolio that we have created to do a certain objective.
Okay.
And the objective is to defend from our growth risk that we have in our portfolio. And if you remember from the asset allocation study, we have close to almost 90%, and we have huge risk in the portfolio for growth because we need it. We're seeking return.
Right.
So then this is more of a protector. So this is actually better to move to a portfolio.
Okay.
It's a specific strategy. So I think it's moving to more industry standard to call it a portfolio rather than an asset class.
And that's the language I think I've been thinking about, is like, it seems like a strategy, but it's not just a strategy because it's actual like money being allocated, right? So it's not just a strategy, but maybe it's a strategic portfolio. But no, that's helpful. Yeah, thank you.
The only addition that I would make there is that it's just that it's a collection of so many strategies. So that's why the singular strategy I don't think is comprehensive enough. That portfolio really shows that it has all of these underlying pieces to it.
Yeah. Yeah, I'm always intrigued because it's like T-bills and hedging strategies, and it's an interesting and innovative, and I'm proud of the work we've done. So thank you. That's helpful clarification.
Thanks, Sharon. Anyone else with questions or comments?
Maybe I should. Sorry about the last minute thing.
Ms. Yamamoto?
Okay, hi, thanks for taking my suggestion under consideration, and I really appreciate it. And like Sharon, I was confused when I first got on the board that it was a asset class as opposed to a portfolio. So I was excited that you changed that wording. So another thing that I wanted you to kind of explain is on page 6, there's talking about under the risk management, the authorized staff. Can you talk about the reason for asking for the letters for the internal staff? I just wanted to know just how that came about. It's right before the monitoring and reporting section. I said page 6, so. Did you find it?
It's the attachment too.
Okay.
It's 6 in the red line, just to be
Okay,
clear.
right,
Yes.
6 in the red line, sorry.
The inversion.
So this is updated language. As we mentioned, we're going to more standardized policy language. And a lot of this came in, our compliance team recommended being very specific on who is authorized through this specific process to actually transact on the portfolio. So this is just an enhancement on being very clear who can do what and where you can go find who is authorized to do it.
Okay, because there's a time limit too, like within 24 hours that it has to be a written request, authorization.
Yeah, again, this is more compliance language, and I'm not sure if April would like to come up. Her team recommends best practices regarding.
Hello, April Wilcox, Director of Investment Services. This is really our governance control around all of the portfolios on how to trade. And so this is just updating as we're looking at the different policies. How can we make it stronger and increase our controls and our risk? So this is not specific to RMS. This is actually across all of them.
Okay, so that'll be incorporated eventually for this language. With this.
Yeah, as we start rolling out and refreshing all the policies.
Okay, all right, thank you. Thank you, Mr. Chair.
Thank you, Ms. Ramon. Any other questions, comments? So seeing none, I have a question. The role of diversifier and defender, I guess there are no absolutes, but are there any scenarios or situations that you have discussed or models that you've run where this, in fact, would not act as a defender or diversifier? And essentially the probability of it not doing what it's intended to do.
Thank you for the question, Chairman. It's a very good question.
You've always told me my questions are good questions. It can't all be good.
No, I absolutely mean that. With all sincerity. It's a really good question that you should hold us accountable to. When we think about the RMS program, and as we think about what Scott talked earlier about, trying to build a total fund portfolio, but we're always trying to enhance it. So when we think about the RMS portfolio, if you will, it was built with that intent, is that we're trying to defend with various scenarios, but we don't know what those scenarios would be, and that's why it has multiple strategies within the portfolio. As we're going forward, though, what we're trying to do is enhance the portfolio. So what has come about is that since the inception of the RMS portfolio, there are new tools out there that we might want to include into the portfolio. So we're conducting research and analysis right now. Allborn is helping us with bringing forward those ideals to us. So we're effectively what we're trying to do is build a more effective or more efficient RMS portfolio.
I appreciate that. I view it as it's insurance, and hopefully we don't have to use the insurance, but in the event that we do, hopefully we have the right coverage. So
I just want to mention this relates to something our CIO said a minute ago, that we don't know what the future will bring, and we keep modeling different scenarios to provide protection. So I don't think we can say with 100% certainty that we have that right mix, but we keep analyzing it and throwing in new tools, which is what this policy will let us do now, is continue to add levers to respond in the right environment.
Thank you very much, Geraldine. Sharon?
Yeah, I just actually wanted to follow up on your comment, Harry, about the levers. And so I should know this, but remind me. So your team, Stephen, given Harry's comments, obviously it's, it just seems like in the landscape we're in right now, is RMS doing what it's supposed to do in our entire allocation? So your team looks at that, and then I'm just wondering how that interplays then and how those adjustments are made in the background of our 4-year asset allocation study that we do. Like can you just talk a little bit about that in terms of, I think we've delegated you some room for RMS so that you can make modifications and changes. And then how does that play into when we do the full 4-year asset allocation? Can you just comment on that a little bit?
Thank you, Sharon, for the question. In the January item, we talked about the role of RMS and then how has it impacted total portfolio. So the investment committee received a report from us, and included in the report was a section that talked about how the RMS portfolio, and we talked about since its inception, how it's impacted the total fund.
Mm-hmm.
And so analysis was done, and what we found was that RMS, not entirely on its own, but with other things that were happening within the portfolio, has really helped improve the timeline of reaching full funding. And so the systems actuary actually did a lot of work and analysis, so it was independently done to show that RMS did add value to the total fund.
And I guess I'm asking more prospectively, so that's kind of looking back. But as we think about, and I'm obviously thinking even currently, right? The last couple of months and market tanking on Monday, and I mean, I know we don't look at things from day. I know you do, I don't. But like, think about long term, I guess.
Maybe I'll assist in answering a bit of this from a total fund portfolio view. In our diversifying portfolio, which I talked about in the CIO report, there's RMS, fixed income, and cash. And as we think about the current environment and moving forward, we're asking ourselves, what components of that diversifying portfolio would we like to move forward? And I think in the current environment, we've been investing more in fixed income over RMS. In fact, we're overweighting fixed income over RMS. This was a decision that Stephen and Geraldine and Rosie teamed up on to give us a better gauge. What could be better for us in this environment? And so if I looked at in the current environment, RMS has done well in outperforming the stock market. Calendar year to date, it's actually down, but down a lot less than the S&P, and so it's been outperforming. But if we looked at fixed income, that total return is up. It's up, close to 2%. And the reason why we decided in the diversifying bucket to overweight fixed income is because between Rosie and Stephen and Geraldine, they determined that the return trajectory would likely be better over this period. And if you look back in history, we had been moving out of fixed income into RMS because of the same, sort of differential in reverse. And today we're moving more into fixed income over RMS. I think it's fair to say these are actually really, really difficult questions to answer in regards to what is going to be the defender of the portfolio. And that's why, as we think about the diversifying bucket, it actually has those three components, right? It has fixed income, it has RMS, it has cash as part of it too. And it frankly gives staff the capability to maneuver and navigate depending on changes in the environment, which honestly are going to be hard to predict. But as it unfolds, greater clarity might also allow us to move between those three perspectives. And so again, I think the way we look at it is the best way for us to do is have an overall diversifying portfolio for the total fund. And it's going to in itself be diversified to the degree that we're able to quote unquote defend or diversify the portfolio under a lot of different types of market shocks or a lot of different types of recessions. I think the difficult issue that we have, and I mentioned this again in the CI report, is you never know the trigger of the recession. You never know the depth of it. They're all unique and different. And so if you think about it that way, the unpredictable nature of it, we would be, foolish to design a portfolio where we thought we knew what was going to happen, right? And so instead, we're taking an asset allocation approach, and then as things become more clear, we're dynamically trying to shift it. So hopefully that gives you an understanding.
Thank you very much, Scott. And any other questions, comments? Seeing none, let me just see if there are members of the public that would like to comment on this issue, on this topic.
There are no members of the public in the queue for this item.
Thanks, Samantha. So this is being proposed as an information item. If the committee is comfortable, we could entertain a motion to move this forward as action this morning, rather than having to bring it back. Been moved by Ms. Yamamoto, seconded by our controller. Any further discussion? We want to take a roll call vote, please.
Ms. Whitaker?
Yes.
Controller Cohen?
Yes.
Mr. Tang?
Yes.
Ms. Yamamoto?
Aye.
Ms. Bradford?
Yes.
Ms. Hendricks?
Yes.
Mr. Gunning?
Aye.
Mr. Ruffino?
Yes.
Mr. Garfinkel?
Yes.
Mr. Juarez?
Aye.
Chair, would you care to vote?
Aye.
The motion passes.
Thank you, sir. The motion's passed. We'll take a 10-minute break. We'll come back at 10:30. Item 5 on the agenda is the semi-annual performance report. Alan, Mika, and Stephanie from Makita. And a reminder to the committee that questions or comments about specific investments and/or strategies will be deferred to closed session. This is a high-level overview, a semi-annual general consultant. Mika, turn it over to you.
All right.
Stephanie?
Thank you, Chair Keeley. Stephanie Sorg with Makita. I'm joined by my colleagues Mika Malone and the Honorable Alan Emkin. We're starting early. Here we go. So you have in your packets a much more detailed report from Makita. We'll be reviewing a brief slide deck here that highlights some of the key takeaways that we found in our reports. As a reminder to the committee of the context for these semi-annual reports, you have delegated to staff the responsibility to invest the assets of CalSTRS, but you retain the responsibility of monitoring that authority that you've delegated. And so these reports provide you with the documentation of the monitoring oversight work that Makita has done on your behalf over time. As you know, Makita integrates with your staff more or less on a daily basis on the asset classes and the strategies. So from our perspective, we have a very strong sense of the activity at all times across your investments. We supplement that for these reports in a semi-annual process of providing RFIs to each of your asset class heads and then interviewing those asset class and total fund management heads thereafter. So this report itself simply represents a summary of our findings that we present to you once every 6 months. And so with that, let me just highlight a few key takeaways here, starting on slide 2. At the broadest level, Makita believes that staff continues to execute at a very high level across the portfolio, and our measures for evaluation continue to be overwhelmingly positive, despite us, particularly Alan, being hard graders. The performance of the investment program as of December 31st for the trailing 1-year period was 7.7%. That exceeded the return of your policy benchmark by 70 basis points. It was 2.3% below the return of the median public fund with assets greater than $1 billion, and a bit more below the return of your reference portfolio, which, as a reminder, is a simple mix of 70% global equities and 30% fixed income. The reasons for the 7.7% being below the return of both peers and the reference portfolio are the same reasons that you've outperformed both measurements over longer periods, and that being due to the fact that you have a higher allocation to private markets. The past year is a period where public equity markets did significantly better than private markets, and thus the divergence in returns over the 1 year. Over the trailing 10-year period, your portfolio has returned 7.8% per year on average. This is 40 basis points ahead of the policy benchmark per year, in line with the peer group median, and 90 basis points per year higher than the reference portfolio. Turning our attention to CalSTRS' two largest public asset classes, that being global equity, which we show on the left-hand side of the page here, and then fixed income, which is on the right. Collectively, these two asset classes make up over half of the CalSTRS portfolio, and thus they're going to be meaningful drivers of performance. So what we like to show on this slide here are going to be the 5 and the 10-year returns in Sharpe ratios. That's your measure of risk-adjusted returns for these two asset classes against relevant comparables. And we show the longer time periods because it gives us an idea of how your portfolio would have looked and acted over a potential market cycle. And so when we take a look at the top left table for global equity, you can see that the asset class over the 5 and 10-year periods has returned 9.9% and 9.5% respectively. This performance exceeds all of the relevant comparables you're seeing in the table here. So that being your policy benchmark, the MSCI ACWI IMI, which is the industry benchmark, a broad measure of global equities, and then the peer group median. What the bottom table tells us here is that global equity as an asset class has been able to produce those superior returns while assuming a lower level of risk. And that results in the higher Sharpe ratios. Something worth pointing out here, we've brought it up in the past and it still holds true today, is that there is rhetoric around public pensions manipulating benchmarks in order to set lower bogeys, making them easier to beat. Something that should bring you comfort is that that's not the case at CalSTRS. And I think global equity on the page here does an excellent job of providing an example of this. The policy benchmark currently in place is actually a harder benchmark to beat than that MSCI ACWI IMI, and you can see that articulated in the comparable returns between the two. Moving to fixed income on the right-hand side of the page, over the two measured time periods, this asset class has outperformed the majority of the comparables we have in the table here, both on an unadjusted and a risk-adjusted basis. The slight lag you're seeing against the peer group median here can be attributed to the fact that CalSTRS' portfolio has a bit more of a conservative posture than peers, and that comes in the form of a lower exposure to those higher risk, higher yielding fixed income and credit securities.
Great. As we shift forward to the next slides, we start thinking about what are the risks to your portfolio. In the previous agenda item talking about the RMS portfolio, we talked about some of the ways we try to offset those risks. So this page really highlights one of the large risks in not just the portfolio, but in the marketplace today, which is US equity markets are very richly valued. Which means, and if you look at kind of the far right-hand side of the chart in front of you, the price of stocks in the US today are well above their historical averages, which means not that they can't go up from here, but that when you look at that long time period, we go all the way back to 1881 in this table, in case you didn't notice. So if you go all the way back through time, it means that what is being paid every day today to buy a US stock is significantly above what that average has been. Again, there is no telling how long things can remain expensive, but over time, we do tend to see things move back towards that mean. One thing we note at the bottom of this chart that I think is worth just highlighting and maybe clarifying, we note that in the last 5 or 6 years, a lot of that increase in return from US equities has been driven by what we call multiple expansion. And I just wanted to highlight for those who aren't living and breathing the investment marketplace every day, what does that really mean? We use PE as kind of the standard multiple to be thinking of here, and that means that the price being paid for every dollar of earnings in these large US companies is higher today and has been increasing. As you can imagine, as the stock prices continue to move, it's harder and harder for those multiples to expand on that basis. So when we note at the bottom that over the long term, that's an unsustainable way to see increases in stock prices, that's what we're referring to really, is that it gets harder and harder as those prices are higher to sustain that level of growth. So that's something that the marketplace is watching. Just for what it's worth, these stocks outside of the US have more favorable pricing today. So when you think about these charts in other places, the extremes are not quite as dramatic, and there may be opportunities there. Your team, your RAC, all of the groups at CalSTRS are very well aware of these risks and are managing your portfolio in line with them, but we think it's worth highlighting what that looks like today.
The reason they go back to 1881 is because I'm part of the group. So it's just very important to keep that in perspective. To his credit, Scott already addressed these, so I'm going to go completely off script, which is not unique for me. The issue is uncertainty. And one way we in the investment world look at uncertainty is called standard deviation, which is basically a statistical measure of the range of returns around an average. And for those of you who are not familiar with the term, so if you had an expected return of 10 and a standard deviation of 15, you would expect it to be plus or minus 15 off of that average. What's changed is probably the range of that standard deviation is broader. We should expect higher highs and lower lows, and I'm of the opinion that it will be asymmetrical and that you won't see the same level of higher highs and higher lows. You'll see lower lows, and highs have probably already been peaked. So you could look at what we would call a very asymmetric return pattern in the future with greater probability of downside than upside. One measure of that risk is, I just looked at the numbers this morning, there's a measure that we in the investment world use to look at domestic equity risk. It's called VIX. It's a voluntary measure of the expected volatility in the US equity market over the next 30 days. That measure of risk is increased 40% on a year-to-date basis. That's truly meaningful. That means the range of expected returns has gone up dramatically. But the biggest risk, and this is based upon 40 years of advice, is don't allow yourselves to be distracted by all the noise. You're here to provide benefits to teachers over the next 30 or 40 or 50 years, and that's your job. And all the other stuff, is it important? Do you have to listen to it and deal with it? The answer is yes, but that's your job. And sticking to your knitting is really the most important risk for you to manage going forward, in my opinion. And Scott can take care of the rest. Happy to answer any questions.
Oh, we're not finished yet. Apologies. Alan. Thank you very much. All righty, so Scott teed this up for us during his CIO comments, but each consultant was asked to provide a bit of education from the lens of our prospective oversight on the topic of private markets. So I'm very excited to keep this pretty high level and approach it from a total portfolio perspective. We have a couple slides on the trends and the rationale here for private market investment. So on slide 6 here, allocations to private markets have been increasing over the years, and CalSTRS is really no exception in this case. Since the early 2000s, the average pension allocation to private markets has grown by roughly 60%. Now you ask, what are some of the motivations for doing this? They can include areas such as searching for higher returns, diversification benefits, exploiting market inefficiencies, regulatory and policy changes that allow for a greater footprint for pensions in this space, just to name a few.
The next slide takes a look at what have we seen from private market asset classes relative to public markets, and then what are we thinking of going forward? So this ties into that longer term conversation that we touched on earlier around asset allocation at the total plan level. So if you look at that table on the left-hand side and you look at the historical 20-year return by asset category, you see that private equity's 14.3% annualized return over 20 years is at the top of the bunch. You move your way down the page, you've had quite strong performance from many of these asset categories, with the notable exception of US fixed income. Recall that until recently, you had sort of declining rates across that time period, which had a lot of pressure on the US fixed income market. So when we look forward, these are using Makita's 2025 capital market assumptions. And I don't want to drill too much into this because there'll be much more robust conversations in the future. But what I think is important is to kind of think of the past and then note what is really important is how CalSTRS is positioned for the next 20 years. And a couple of things have changed and a few things have not. One, you'll still need equity risk in your portfolio. You see the return expectations for private equity and global equity are both among the highest in the broad asset categories shown here. But your private equity expectations have come down a little bit. There are a lot of reasons for that, which we'll get into at future meetings, but still in the double digits for private equity. If you look at global equity, those return expectations have come up a bit. A lot of that is actually thinking about opportunities outside of the US as well. So wanted to just highlight that. I touched on it a bit earlier. If we go to the next slide, and this is really the last slide, kind of thinking about this private markets topic, also wanted to highlight just what has it meant for your portfolio. So I gave you broad asset class performance on the last slide. This is how has CalSTRS overall portfolio done inclusive of private markets across time periods. So we're looking at a couple of different things, and I'll start my comments on the right-hand side with the table. What we're showing here is your historical outperformance of your total portfolio versus that reference portfolio. So that 70-30, because one of the conversations we all have, both in the industry and here at CalSTRS, is it's expensive to invest in private markets, right? You're contributing capital to an illiquid asset class that's tied up for a long period, and you're paying to do so. You're able to negotiate much more favorable fees than many peers, but it's still more expensive than putting it in an index fund in the S&P 500. So why do we do it? You look at your total portfolio performance here, and we've broken that 100% of the time and shown you how often CalSTRS outperforms that reference benchmark, or how often you would have been better off just putting it in a 70-30 simplistic index fund approach. And you see that 71% of the time you were better off with that CalSTRS actual portfolio experience. That's pretty robust. That's not 52%, 48%. To me, that's meaningful and statistically significant, maybe more importantly, results coming from your portfolio. When we look at what the actual returns are in the center of that table, the 20-year return for your portfolio at 7.2% also exceeds by 70 basis points the reference portfolio at 6.5. Those are real dollars. You have a very significant portfolio here at CalSTRS, and those incremental basis points year in and year out mean something to the benefit payments that you're making to your beneficiaries over time. And then finally, and Steph touched on this a little bit earlier, you have been able to produce those returns with a standard deviation that is below that of the reference portfolio. And a big factor in that is that private markets are not marked to market daily, so they have a smoothing effect on your experienced volatility across a long time period. I don't think it's particularly relevant to think about any individual one-year period on this basis, but it is worth noting that over that full 20-year period, you see that annualized standard deviation significantly below the reference portfolio. The periods of time you expect that to help you are actually in periods of significant long-only equity market drawdowns. So early, for example, in the financial crisis on the left-hand side of the line chart, you do better than the reference portfolio, right? Because it takes longer for your portfolio to see the negativity that's exhibited in public markets. Then you see a short, sharp downturn where a portfolio with significant private markets, you'd expect to lag the rally in public equities. And then over the long term, again, more often than not, again, 71% of the time, it is to your benefit to include those private markets in the portfolio. So that was really the broad picture we were hoping to share with you, just in terms of the proof statement of why you have a lot of people on staff, you all spend a lot of time, and your various consultants spend a lot of time in this area of your portfolio. That is the conclusion of our report, Mr. Chair. We're happy to take questions.
No, it's not. I'll be very quick, Mr. Chairman, with your permission.
Absolutely. Sir Allen, go ahead.
Just a few things that are important to keep in mind. Number one, in the report, it talked about how value is added in the equity public equity portfolio, that came from two ways. Number one was a big commitment to index funds, which saved you money on fees and internal management. And number two was good manager selection. So there were two skill sets that were involved there that are really important to acknowledge. The other thing is how much money you saved in terms of internal management and a collaborative model, co-investments, hundreds of millions of dollars. And every time you save money, that's that much less you have to earn somewhere else. So, and you saving money is a risk reduction. So those things deserve to be acknowledged, and I've done so. Thank you, Mr. Chairman.
Thank you, Mr. Lampkin. And I want to thank Makita. This was a good report, but an excellent presentation and summary. Terrific job. And not surprising, I think it's better that we heard it from you, Ms. Lampkin, but the importance of manager selection. With the amount of capital and managers who are now in the private markets, the single most important decision our staff makes is who do they allocate the capital to and how do they negotiate terms. So those trusted partnerships that we've established over a long period of time to ensure that we can pay benefits to teachers like the woman we saw at the beginning of this meeting is a differentiator. So I thought your presentation and overview and summary was excellent in highlighting why we do what we do with our appropriate oversight. And kudos to the staff for your manager selections and how you've allocated the capital in the past. But tomorrow's victories aren't yesterday's victories. So stay focused, stay steady, and really good report. So Mr. Juarez, you're in the queue, and then Mr. Ruffino.
Ellen, I noticed on on the panel that you were speaking to, and this also would go to Scott as well, we aren't necessarily acknowledging the impact that the substantial federal layoffs are going to have in terms of spending of the dollar, the multiple impacts, the down the stream impacts. And I'm just wondering whether that poses a real concern for us in terms of where we invest, given what's going to happen once all those layoffs and job eliminations come forward.
Sure, I'll kick it off. I think their bottom line is going to be an impact to the unemployment numbers, but I think more worrying is the unstrategic, possibly unstrategic nature of the cuts. What do we need for this country? What areas are important for us to not only, I mean, you have the unemployment piece and maybe a little bit of a hit to GDP, but I think the greater issue might be, as a country, how are we coming around the important components of what's necessary to sort of run USA Incorporated, so to speak, or if you think about it at an aggregate level. So I don't want to undermine that the cuts are going to hit a little bit of GDP and some unemployment, but I think there's the broader impact to me would be the decision of strategically what gets cut and what gets kept. And I think that uncertainty is creating a lot more ramifications than potentially the level of unemployment that could ensue from this. But Alan?
Just in terms of the big picture, believe it or not, the federal workforce, although it's meaningful, is a relatively small part of the economy. I think it's about 1.5%. So in terms of unemployment writ large, I don't think there's going to be a dramatic impact. The dramatic impact will be on sentiment, and that is public employees, federal employees have cousins and uncles and aunts and friends. And collectively, when they see people being unemployed, they spend less. And so that sentiment indicator could dramatically impact the economy. The bigger issue from my perspective, and I don't claim to be an expert, I just claim to be old, is when you have fewer people managing these programs, what falls through the cracks? Does someone not get a Social Security check? does a school district not get a check from the federal government and they have to borrow money to keep the doors open? No one knows what will or will not fall through the cracks when there is dramatic change from the current structure to whatever new structure evolves. And the biggest challenge, Mr. Juarez, is no one knows. And that just creates uncertainty. And when there's uncertainty, people spend less money, and that could slow down the economy. I hope that answers your question.
Yes, it does. Thank you. I wanted to respond to Stephanie about the investment or pension funds juicing their bottom line benchmarks. And my experience has been, it's typically not the pension funds, it's the people they do business with. The investment managers, and all due respect if any investment managers are in the audience, I've never met an investment manager who hasn't met their benchmark. I mean, it's incredible to me that every presentation I've ever seen is that we've exceeded our benchmark. And it's like, how's that possible? Then that means somebody out there is not. And obviously we're not doing business with them. But it just was curious that you would say there was a hint out there that pension funds were doing that. And I don't think that's the case. So anyway, thank you.
Thank you, Mr. Juarez. Mr. Ruffino.
Thank you. Thank you, Mr. Chair. And thank you to Stephanie and Mika and to your honorable for the presentation and just a immediate feedback. I really enjoy your education topic. You know, those 2 slides that tells a lot of the story. And Mr. Chair made, I concur 100% with him, just excellent presentation to concise. With respect to the capital market assumptions, right, and the asset allocation decision strategy, I have a question about that. So given the evolving microeconomic environment, such as inflation trend, the interest rate expectations, geopolitical risks, which we've been talking about it all morning, and this is where this question is, whoever has got the best crystal ball. How do you anticipate that these assumptions will shift over the next 10 years?
I do not have the best crystal ball in the room. I'm confident of that. But the comment I will make in this, just for anyone looking at the pages, I think we're referring to page 7 of our deck here on capital market assumptions. It is so challenging to produce forward-looking expectations, right? We're trying to look out 10 or 20 years, which even with perfect information today would be an impossible task. And then you add the uncertainty that I think everyone in the room has highlighted in the present time, making that even more challenging. So I don't mean to dismiss that it's important and that we will continue to absorb that information and use it as we update our assumptions and as your staff and other institutions update theirs going forward. But what we try to do is every year take in all of the data points that we have to that point, and sometimes intra-year, right? If markets get extremely volatile, we will also update these assumptions more frequently. But broadly speaking, because you're looking out 10 or 20 years, the models for things like fixed income tend to hold up relatively well over a 10-year period, right? You can buy bonds today over a 10-year period. You have a pretty good sense of what that yield to worst and what that outcome may be. In the equity markets, it is much more challenged in things like private equity, where you add policy, equity returns, premiums, illiquidity to the equation, and future technological advances. I think it becomes really, really hard. So what we try to do is accept the fact that there's much we can't know, take the things we do know, and then not use a crystal ball, but try to make the dartboard that we're all throwing at down the road a little bit more clear, right? And try to highlight what those risks are and do a lot of scenario testing and other types of analysis that we think can provide you as fiduciaries and as trustees a little bit better handle of what the risks really might be. I think we do a pretty good job of helping to highlight the risks. I can guarantee you that none of those numbers on the right-hand side of the chart will be what you see from those asset classes going forward.
I do agree. You're doing a good job. Thank you. Thank you, Mr. Chair.
You're welcome, Mr. Ruffino. Seeing no one else in the queue, thanks, Alan. Thanks, Stephanie. Thanks, Mika. As they're leaving, Taylor and Ben. our real estate consultants from RFA. And Taylor, I didn't get your permission, but on behalf of the board, our thoughts are with you and your family. We know you've been displaced as a result of the tragic fires in Pacific Palisades. You've been in our thoughts and our prayers. And we're thankful that you're here with us. And I know you're going to be part of the solution in that area. So
yeah, thank you. Very much appreciated on behalf of so many in Palisades, Altadena, other parts of California that are displaced. So thank you very much.
You're welcome.
All right, good morning. Ben Maslin with RFA. We've organized our presentation to talk about the performance of the portfolio at large as well. We're going to talk about the real estate markets and perhaps somewhat about our crystal ball or lack thereof, and then we'll get into some education materials as well. So two key highlights before we jump into the slides. Number one is that the allocation of the real estate portfolio dipped below 13% during the last 2 quarters, which is about 200 basis points below the 15% target. We'll get into the reasons why. The second thing is that with regard to performance, long-term performance has been strong. It has outperformed the benchmark, but the one-year performance has actually lagged the benchmark, so we'll get into that as well. And let's start with performance. So you can see here the 10-year return at the total level outperformed the benchmark by 120 basis points. If you exclude legacy assets, which just as a reminder for the members include essentially commitments to funds before the great financial crisis. So they still have a detrimental effect to the long-term return. That outperformance is 190 basis points. And the portfolio outperformed the benchmark for the 3- and 5-year periods as well. On the 1 year, the portfolio underperformed, and really the reason is due to that continued drag from office investments, and in particular life science investments that hit in Q3 of this past year. The staff is focused on improving sector allocations, reducing the office exposure, and in particular life science exposure, to rebound performance going forward. And again, the focus should be on the long term and not necessarily short term volatility of returns. Then looking at the allocation, so this shows an allocation of 13.2% on the left-hand side. The target is 15%. You have a plus minus range of 5%. So anywhere from 10 to 20%, you're within the compliance guidelines. During the quarter, it dipped down to 12.9%, and then now it's at about 13.2%. And again, the reason is that real estate appraised values, which is what your allocation is based on, have declined by about 20% from peak to trough. The stock market, on the other hand, has gone up essentially 20% per year. And so when you combine those two, you end up having a lower allocation. What you're at now is a position to withstand market volatility, especially in the equity markets, and that you are committing additional capital to real estate to essentially try to bring the allocation close to the target. And then in terms of we always like to show this chart because the allocation by property type is influential on returns. This shows essentially an over-allocation to office properties and under-allocation to industrial multifamily properties. And that in large part is due, well, I should take a step back. The office allocation has continued to decline over time, but remains a little bit above the benchmark, and that in turn has corresponded to a lower return over this past quarter. With that, I'll turn it over to Taylor to talk about the market.
Yeah, sure. Thank you, Ben. Thank you, Ben. Taylor Mammon from RCLCO Fund Advisors. So really quickly, just to provide a market overview, I'll first start by noting that when it comes to market fundamentals, not much has really changed since the last time we spoke to you. We're seeing continued improvement across most property types and multifamily. We're seeing excess supply getting absorbed in the Sun Belt, improving performance in gateway markets. Office continues to absorb the impacts of changing work styles, and so vacancy is increasing. Retail, which here is predominantly neighborhood retail or grocery anchored retail, continues to be very steady, well performing after years of no construction really taking place in that sector. And industrial continues to be healthy given the impacts of e-commerce and nearshoring and reshoring of goods storage and manufacturing. And it's of course important to point out that real estate is of course local. And so these are national statistics. They vary fairly significantly from market to market. And that's something that staff is very attuned to when it comes to selection as well. The biggest change, therefore, since the last time that we presented the semi-annual report is the inauguration of a new presidential administration under Donald Trump. And it's important, as we've really been discussing all morning, to break down the implications of this into what we know and what we don't know. And we recognize that what we don't know is that list is much longer than what we know. What we know and what we're seeing in terms of implications is an intention of this administration to disrupt longstanding norms, policies, practices, and so on. That is, as we've discussed, making capital markets in particular uncertain and maybe even anxious. That has in turn led investors of all types of assets to demand higher returns on their assets and those that they're buying. When an investor demands higher returns, it means they're willing to pay less for things. And I think we're seeing that really across asset classes at this point. And real estate is actually a bit of an exception there because real estate has been so hammered by increasing discount rates for a couple of years. It's remained fairly steady in the last couple of months and quarters. So in any case, we do continue to expect uncertainty and disruption, which should maintain high discount rates, high interest rates, demanded for assets. What we don't know is really the extent of the disruption. We don't know really over the long term what the tariffs will be. We don't know whether mass deportations and so on will start. We don't know what the actual cuts to the federal government, changes to the federal government will be. We don't even know whether there will be tax cuts and what form those will take. And that is going to have a huge impact on an ongoing basis on the capital markets. Maybe eventually we'll find out, or we will eventually find out, what impacts these changes will have on actual property markets, the demand and supply of real estate. So investors like CalSTRS are left with what to do in the face of uncertainty. Again, we've been talking about that all morning and agree wholeheartedly with Scott's approach to emphasize diversification. And that goes within the real estate portfolio as well. You're certainly, as an investor, going to lean in or lean out of different geographies, property types, and so on. We are recommending clients to lean into those areas that are demonstrating and almost kind of insuperable long-term drivers of demand coming from demographics, technology, and so on. But to maintain an eye on what is going on in Washington and other state capitals or national capitals, to have caution relative to property types and geographies that might be on the target of policies and approaches that the government might take. And we're happy to talk about those in detail, both in open as well as closed session. And we'll open that up to questions.
Thank you, Taylor and Ben, for a good report and overview of a summary. Any questions or comments for Taylor and Ben? I think, Mr. Gunning, you're going to log in? You can figure it out. I believe in you, Mike.
Thank you, Mr. Chairman.
Welcome, sir.
Taylor, Ben, good to see you. I guess question of the day for me would be the governor's order for employees back. I know we've been waiting for that for our perspective with the headquarters expansion, but any comments or thoughts about that? And then more globally, rebuilding in Los Angeles and impact that way as well.
Sure.
Thank you.
Take first, I'll take that.
Yeah. Yeah, the return to office mandates, it's not just the public sector, by the way, it's also the private sector, right? There are many private sector employers that have mandated return to office. What we can look at is key card swipe data. We can actually look at real data in terms of how many people are actually in the office per day, and it has remained, it has ticked up slightly. I want to say and I want to emphasize slightly, but on average, the employees are there 50% of the time in terms of physical occupancy, and that's been the case for the last 2 years. This may slightly bias that up a little bit, but I think that our perspective is that a hybrid work environment where you're at home partially and you're in the office on average, maybe 3 days a week, is here to stay, at least for the medium term, as that has become the norm.
We think that means that certain days of the week, in particular, we're seeing Tuesday and Wednesday as days in which there's almost full occupancy in, I would say, high quality office locations where employers want to be, where employees want to be. That should, of course, maintain a certain level of demand, with occupancy trailing off on kind of the near the weekend days, Monday and Friday. What we're seeing overall in office, though, is that because employers continue to be in a battle for talent, is a flight to quality in terms of what they're looking for in office space. They want to provide the best buildings, resources, amenities as possible to have carrots to bring their employees back, more than sticks at this point, since those sticks aren't necessarily working. People are voting with their feet. And so we're seeing definitely a flight to high quality. And then to your question about rebuilding, so as I'm sure you can all appreciate, the biggest impacts of the fires, the Palisades fire and the Eaton fire, were on single-family residential real estate to a large degree, with significant but still much less impactful, much lower impacts on commercial real estate to a large degree. So institutional investors are not necessarily exposed to the damage that's taken place directly. Where we think the challenges will be are in the insurance markets, which have been over the past few years and continue to be battered
A little bit
by.
of a sore topic, Taylor.
Believe me, I know. And it will carry through to a certain degree to commercial properties and insurance policies as well. It remains to be seen to what extent. But I think all investors at this point in time, and we're working with investors from around the world that are evaluating investments in California, are underwriting higher insurance rates for the state of California. That's going into their assumptions, which in turn has a negative impact on values that people are expecting. In terms of the rebuilding, I think there's a great deal of momentum from both the public and the private sector to rebuild in a way that is as affordable as possible, is as quick as possible, and ends up with results that are as resilient to fire as possible in the future. As a resident, as well as participant in these rebuilding efforts, I recognize that process is not going to be linear. It is going to be a bit of a roller coaster, but optimistic that both the public sector and the private sector will rise to the occasion.
Thank you.
Sure.
Controller Cohen.
Thank you. Good morning. My question is more on the industrial vacancy that we see, almost like a stepchild when it comes to conversations when we talk about real estate. I was wondering if you could talk to me a little bit more in depth about the graph that you have on that, what is that, on the far left, my right, industrial, we were at the historical average in particular. I was just wondering if you could explain to me that change in percentage.
Sure. So essentially, Controller, I believe you're asking about the decline relative to the historical average. Yeah, so the primary reason for that is that really since 2015, when e-commerce started taking a much more meaningful share of total retail sales, demand for warehouses, which is where e-commerce is essentially housed, increased dramatically over that time period. And in certain markets, including Inland Empire and California, the vacancies actually got down to less than 2%, which is effectively fully occupied at that point in time, leading to just tremendous rent growth in that area and around the country. Typically, when you see that type of rental growth, you also see a response in terms of construction. It sends a signal to the market that the market needs more space and that developers can make significant profits by delivering new space to the market. And so that's what we've seen happen over the past few years. Development is slow. It takes amount of time, so it doesn't respond instantly to the market demand, leading to typically some quarters in which more supply is delivered than tenants that demand it, which is why we've seen industrial go from 4.4% a year ago to now 6.2%, again, largely due to additional construction over the past year.
Additional construction. So are we also seeing rents for these industrial spaces going up?
So we saw dramatic rent growth in the years right after COVID when there was a flood of demand into warehouses for e-commerce purposes to store additional goods and so on. We've seen that moderate, and you can see that on the right-hand chart, which shows rents going from what they would have been 12% nationally 2 years ago. Last year, they were 4.3%, which is still very healthy rent growth, more than most are going to underwrite over the long term. And we see that, again, moderating between now and 2027 to about 4% rent growth. Still very healthy, likely above inflation, just reflecting continued demand from e-commerce, as well as continued reshoring of both storage of goods to ensure that retailers are able to respond to supply chain impacts better than they did in the years following COVID, and potentially as a result of increased reshoring of manufacturing as a result of current industrial policy.
So how would the tariffs impact? Because I'm thinking of you talked about supply chain.
Yeah.
Building industrial places, we're talking about overseas imported goods. I mean, to me, that seems like that would drive the cost up, which might make the developers of industrial space a little more hesitant. Even if the market is saying, hey, we need more space, we need more industrial space, that their hesitancy because of the uncertainty, and you heard the earlier presentations about uncertainty and how it is affecting the market.
Yeah.
Is it affecting it in the same way or a similar way?
So I'll answer that in a couple of ways. So first of all, entirely agree that tariffs are going to have a significant and probably more immediate impact on industrial real estate than any other asset class. And that they will have maybe counter balancing impacts. So on the one hand, tariffs are designed to and probably will lead to more domestic manufacturing, some reshoring of what's been done overseas. That will lead to increased demand for warehouses, which is essentially industrial. So industrial is probably more than these other property types a beneficiary of potential tariffs. At the same time, you're absolutely right. The costs of everything to build those industrial properties increases. I generally, our belief is probably that those cost increases will be passed through to consumers as much as anything else, which is why, just one of the reasons why tariffs are inflationary in general. I think the warehouses will get built. It's just going to increase the prices of everything as well.
Yeah, just to add a little more context as well. If you take some of the largest industrial markets surround port markets, so Los Angeles and the Inland Empire, which are near the ports of Los Angeles and Long Beach, were the largest ports in the United States, northern New Jersey as well. To the extent that tariffs increase prices and then thereby reduce demand, that then reduces the volume of imports, then that can reduce in turn the demand for warehouse space in those port markets. Other warehouse space is essentially for distribution internally at nearby markets, and those assuming demand does not decrease, those would be less impacted, would be our estimation. The one other thing to note, though, is that the forecast of returns for industrial amongst survey participants by the Pension Real Estate Association is lower going forward than other property types, whereas previously it was the highest returning property type.
I'm from San Francisco and spent 8 years on the San Francisco Board of Supervisors and did a lot of work around industrial and light industrial, enticing people to build. But I'm curious to know, because you have a larger perspective in terms of the United States that you're looking at, light industrial space falls under industrial by your definition?
It does,
okay.
yes.
So as office space, as we see vacancies growing for office space, do you think people will pivot, businesses will pivot into light industrial space? For example, you see a lot of it, radio stations. I'm thinking about AI, I'm thinking about tech, I'm thinking about data centers. I don't know. What are your thoughts around that?
You know, it's interesting. It depends a lot on the market.
Okay.
So in some markets like Los Angeles,
Right.
for example, light industrial has absorbed significant amounts of office demand,
Right.
largely because it's a creative industry.
Exactly.
Tenants can do interesting things with those light and industrial spaces. And so you see submarkets like El Segundo, which is just south of the airport, absorb a lot of industrial that was previously used in aerospace for, you know, cool entertainment offices or tech offices and so on. So you do see that.
And as a business owner, I think it's more attractive.
Yeah, no, absolutely. In other markets, however,
Yes.
that have different tenant profiles, we're actually seeing, in some cases, the reverse,
Really?
where office is being used by tenants that might have previously been in light industrial because of shortages of industrial space, as we see on the slide, and excess of office. And so what potentially 10 years ago would have cost much more to be in a Class B office or something is now much more affordable than being in a light industrial building. So it's been an interesting shift to observe.
Do I have time for more questions about retail? Okay, let's shift to retail now.
Okay.
Okay. This is one of my favorite asset classes. I don't know why, I really enjoy real estate. Retail. So, Member Gunning mentioned the governor's order, and I said from San Francisco, the mayor of San Francisco also had an order saying we want everybody to come back to the office. And so we talk about the impact of businesses in the retail corridors around the downtown Sacramento, around the Civic Center, around downtown LA. But how does that impact neighborhood retail? Because the neighborhood retail also boomed and you have small business owners that made investments to their property.
Right.
Rents went up as well. People were expanding, due to rents increasing, businesses had to contract. I'm talking about like retail, like in our own neighborhoods, the main corridor. Yeah. How's the neighborhood retail? Talk to me a little bit about these two graphs about neighborhood retail, if you can go into a little bit more detail.
I was just gonna, so the story with neighborhood retail is almost the opposite of industrial in that, first off, industrial, you saw weakening in industrial fundamentals due in large part to a larger number of supply deliveries. In neighborhood retail centers have had almost zero new supply deliveries. As a result, what you see on there is that the year-over-year change has been actually rather robust in terms of rent growth at 3.6%, which is higher than the historical average. The other thing is that a lot of these neighborhood retail centers have been more internet resistant, right? So if you go to a grocery anchored center, people still grocery shop or shop at a grocery store. They still go to the nail salon, right? They still go to these inline retailers that you cannot simply do that service online. So it's been more defensive than other types of retail sectors. Going forward, do we see a drawback in demand as a result of returns to office or changes in demand? Not necessarily. I would say that people still need the same services. They still need to grocery shop. There's still no new supply, no deliveries being built for this type of product. So we would see, this is probably the most steady course type of property type.
Yeah, well, at the same time, returns to office mandates and return to office culture that we're seeing should improve what we call high street retail, which is essentially urban retail, street retail in cities and so on, which has suffered enormously, across the country as a result of the hybrid work and remote work. So we are seeing kind of steady improvement in that area.
Thank you. I appreciate the comments. Back to you.
Thank you, Madam Controller. Any other committee members? Seeing none, Taylor, Ben, thank you very much.
Well, to continue the education, if you'd still like us to provide some education on the private markets, we're happy to do that.
Do it.
All right, great.
Go ahead.
And we'll try
and
to
we have closed session for more.
Okay, sure. We'll try to be
No,
efficient,
take your time.
Okay.
This is important.
Okay, sure. Yeah, thank you. So just to advance the slide. So we were asked to share information regarding private markets and specifically how institutional investors access the private markets within real estate. And, before we talk about, for some reason I'm stuck, but before we talk about, so if somebody can advance this, thank you very much. Before we talk about the specific vehicles or approaches that institutional investors use to access real estate, it's important to talk about the goals that they have, some of which can compete against each other. Thank you. So in terms of structuring portfolios, investors are looking for transparency into their investments and control. They want to ensure that they can make changes or understand what the risks are within their portfolios. They want to have some control over how assets are levered. They, of course, want to make sure that in terms of how their partners are paid, that there's some alignment in terms of fees and incentives. They'd love to have as much liquidity as possible. So this is kind of like the wish list that an investor is going to have. And as we know, with our own personal wish lists, you oftentimes don't get everything that you want. You have to make choices, and each different vehicle type that investors have to access private markets comes with kind of these positives and negatives. So to outline the different approaches to invest in private markets within real estate, we've listed them here, from public securities and funds of funds, which are fairly hands-off, where you don't have much control over the real estate outside of making a buy or sell decision of your security, essentially, all the way to separate accounts, where you're working with a general partner, but generally have significant amounts of control and transparency into your investments, or even direct investing, where an investor, and CalSTRS doesn't do any of this, but other investors sometimes own assets directly. The fund owns the asset directly, and they hire property managers to kind of oversee the property. And so the primary takeaway from this slide is that the more direct you go in terms of owning real estate assets directly, the less expensive it is to manage, because you have to pay fewer people to kind of oversee those assets. The greater control you have, of course, but also with the greater control, the more expertise and capacity you need as an organization in order to oversee those investments. So lower capacity, you're kind of left with nothing but commingled funds or other investments that don't require a lot of oversight. If you have greater capacity, greater expertise, you can then move into again, more fee effective, more control, but more direct vehicles that require more oversight. So just to summarize those advantages, so the collaborative model, which essentially relies upon more direct types of investing, has tremendous benefits. You have greater control. You really can control your destiny as an investor. You can learn from your partners and coordinate with them. You have better transparency. You know what you have in your portfolio, therefore you know what risks you have. You can structure greater alignment of interest with your partners. And overall, you probably have lower fees, and we absolutely see that in the CalSTRS portfolio. The costs of those benefits are essentially greater complexity, meaning greater oversight, and sometimes there are managers who you'd love to be able to work with, but just who don't do that. They want to have entire control. So I'll turn this over to Ben to kind of continue the conversation about different approaches.
Yeah, so I'm going to touch on REITs, which CalSTRS has an allocation to, and which are a very large part of the institutional investable real estate universe. And so, really, there's a few primary advantages with REITs. One is that they are liquid; they trade on exchanges. There's like a stock. Two is that they many of the REITs access specialty or niche property types, which are oftentimes more challenging to access with managers in the private markets. And then three, oftentimes they can be lower cost. And so that comes though with a drawback. Over the long term, REIT performance generally matches private market performance. And you can see this chart that we have on here where that is the case, but that there's a lot more volatility. So you see that red line, which represents the REIT index, moving a lot more than that gold line, which represents the Odyssey or benchmark. The result is that REITs have a lower Sharpe ratio. In other words, they're less efficient for diversification with the rest of your portfolio. And then just to double click a little bit on the composition of REITs versus the Odyssey, you can see on that bottom column there about 55% of the REIT index is in these specialty or niche subtypes of real estate, whereas the Odyssey is about 14%. Just highlighting the access points that REITs may give you for these specialty property types, which we've spoken about in the past as having quite strong long-term demand drivers in general. And then my last slide is one of the things that we were asked to discuss as well is CalSTRS internal processes for investing. Really, it's a simple process where there's an identification of the strategy that by staff. There's then sourcing or identifying the partner or the manager or the vehicle to invest with in that strategy, then diligencing. And this is where it's done. There's two prongs. One is internal. CalSTRS staff internally does diligence, and then there's an independent fiduciary that's also hired as a second set of eyes. And then there's an internal voting procedure by the investment committee, and then finalization, which is documenting and going forward with the investment. Happy to answer additional questions.
Questions for Taylor and Ben? The additional second set of eyes, the fiduciary for real estate, if I recall correctly, a couple of meetings ago, we made a decision in private equity to become more efficient and actually reduce some costs. Is that something that you and the team have considered for real estate, something you've discussed? And is it something that potentially should come back to us for consideration?
We haven't discussed it. I would say that the requirement for an independent fiduciary is that a new commitment to a new manager or a new vehicle. So it's not for a new investment. But yes, it is something that we should discuss with staff, and it should come back to you.
Yeah. So I'm going to ask that. Come on up, Julie. That be taken under consideration with the staff and appropriately communicated with Sharon and myself before it comes back to the full committee. But just as it was taken under consideration for private equity, just curious as to why it wasn't adopted for real estate as well.
Good morning, Julie Donegan, Director of Real Estate. We have a process where we generally have one or two independent fiduciaries work with staff when we're bringing new managers or strategies to the portfolio. But we can certainly go back and address consistency with private equity. But historically, we have done one or two independent fiduciaries that opine alongside staff.
And I would just add on to Julie's comments. I think this is a good idea to take it back, actually, because we've evolved and of course have more complex structures, more staff around it. And I think with an eye towards efficiency, let's go back and take a look at it. I agree. I think this is a good endeavor.
Great. Thank you. Taylor, Ben, anything else?
That is it.
Okay, thanks.
Thank you.
Thank you.
John Haggerty and Tad Ferguson. and Stephanie. Okay.
She's back.
Morning, John. Tad, Stephanie.
Great. Thank you. So John Haggerty, Makita. Tad Ferguson, Makita. Good morning.
And Stephanie Sorg with Makita.
So we're going to switch it up a little bit and start with the education. We have our semi-annual report as normal, which covers through September 30 of last year. But I want to pick up where our general consulting report left off with respect to private equity as an asset class. It's not been the place to be. The stocks have been the place to be for the last 2 years, except for the last couple of weeks. And there's a lag effect that we've talked about many quarters when we've been here. But long-term, private equity has continued has been your best performing asset class. The capital market expectation studies that we do continue to show for various reasons that it will continue to be the highest performing asset class. And I think the real question to ask is why is that? There's been a spread that we expect, an additional return over stocks that we expect over time. And it's been described in various conversations as compensating for illiquidity. Certainly that's a component of it. The other part of it might be additional risk that comes through owning smaller sized companies. And the other part of it, which I think is more instructive to think about on a go-forward basis, are some of the other advantages that we've talked about why continuing to invest in private equity makes sense. It's the alignment that you have through a control structure between your manager and the management team of the company. There's the operational improvements, and there's also the alpha potential. This is a very inefficient part of the market where our skilled managers can add value. There are two ways that you get your exposure through funds. This is very much a 101 private equity comment, but a fund is a 10-year lived vehicle. It tends to own 10 to 15 companies in it. And how it differs from your other mode of investing, which is the co-investments, is that co-investments are made immediately, you get the exposure immediately, and they give you a certain amount of additional control over a portfolio construction because you know what the company is, you know what the industry is, and you can make that selection yourself. We talk about scale a lot as a major advantage for you. It's also a disadvantage in some ways, but we do want to illustrate that when investing in private equity and you're considering it as an asset class, scale can be a big differentiator. And I think for CalSTRS, it really is. It adds to the appeal of making the allocation to private equity. You get discounts not only with your fund investments, but you get huge discounts with respect to the co-investments that you do. And Alan Emkin earlier talked about the massive amounts of fee savings that come from getting those investments at no fee and no carry. And then lastly, your size and your reputation and the amount of time you've spent in this market means that you get very good information flow. Next page talks a little bit about process. This is going to echo a little bit about what the real estate folks just talked about, but you're very selective. We don't talk a lot about the process that results in the portfolio that you have. There are right now over 13,000 funds that would be pleased to be investors with your plan. Last year, you invested in 26 funds. So that's a massive amount of selectivity. And that amounts to 1.5 trillion in commitments that are happening globally. So it's a very, very selective program. You committed to $3.5 billion across 26 partnerships and 1.5 billion in co-investments in 2024. The numbers for 2025 might look fairly similar to that. Importantly, it's a blend of existing managers of what in the industry we call a re-up or a recommitment with a group that has provided a satisfactory relationship, good performance, and is set up really well for the future. A sign of a healthy program, and I think that you do have this sign or this marking within your program, is a mix. Is that you're committing to new investments, you're recycling capital into strategies that are run by different firms that might be on the ascendance rather than being quite large and maybe having your best days behind you. This is mostly a bottom-up practice. I think it bears repeating that compared to the other liquid asset classes that you have. Most of the value add that you have is in pairing yourself or partnering with general partners that are superior. So when we talk with staff about what you're doing, we talk about some long-term strategic things. We talk sometimes about tactical things, but what ends up in your portfolio are a combination of the tactical, the mindfulness about current valuations, but also, and most importantly, the selection of individual strategies and individual people and groups to partner with. You go through mapping of segments of the market. This is a unique concept to private markets, which would apply to infrastructure and to real estate, is before you go about determining where you might want to have your exposures in software, for example, a burgeoning sector for private equity, you will map the market. You will go out and find out about all of the managers that are doing work in this sector, learning who has the best performance, learning about what funds they are bringing to market in the future and which may be fitting for you. The process for conducting the diligence is a little bit different than you might hear from your public team. I would just generally say that the standard has to be higher. You are looking to marry your plan, so to speak, with a fund that lasts 10 years. So logically, the standards for conducting diligence, reference checks, doing the analysis of the track record, et cetera, all those standards are higher and take quite a bit longer to do. The sourcing is the last thing that I'd like to mention that is different about the private market process versus public market process. If your team sat back and expected all the best ideas to come to them, that wouldn't be a successful program for you. In the private markets, whether it's real estate or infrastructure or private equity, you really need to be significantly proactive. It means attending conferences, meeting with your peers in the industry, participating in industry events, and reaching out, frankly, to investors that may not be reaching out to us for your capital. So it's a proactive process. It's very, and it's something that everybody on the team is tasked to do. I'm going to go to industry trends and talk a little bit about what's going on broadly. These are not comments specific to your portfolio. There's been a slowdown in distributions. We've talked about that many times. This has some positives. It's given more time for due diligence. It gives the buyer of the services of private equity managers more clout in negotiation, so not altogether a bad thing. This is a direct result of something else, though, that's going on in the market, which is a slowdown in exits, which has had an effect on your portfolio. Logically, when you can't give money back to your customers to reinvest, the fundraising process has slowed down. So funds have taken longer to raise, but that has given people on the limited partner side more clout, more time to do their work, which is a positive thing. I'll talk a little bit about prices. Earlier exhibits talked about the stock market going way up and being very expensive. We don't have the same metrics, unfortunately, to look at day to day to follow the pricing or the valuation of the private equity markets. But what we do have are measures of transactions. And what we show you in our report are measures of so-called EBITDA, a multiple of EBITDA, which is somewhat like a price to earnings ratio that you hear about in the stock market. 23 to 24, which is basically the time frame for the semi-annual reports that we've just delivered. EBITDA went up for the EBITDA multiple went up about 12 times free cash flow to about 13 and a half times. But the data in this sector is not very good, and I would note that that needs to be caveated with the observation that the deals that have gotten done in a very difficult market like 2024 tended to be the ones that were very high quality and commanding a high price. And also 1/3 of the volume was in the technology sector. So that in itself would make the 13 and a half times multiple that we're showing you here inflated a little bit. When you think about the health of your portfolio, high prices is a fairly good thing. It supports the investment that you have and the return that you're going to get out of private equity. So returns have gone up because the multiples have gone up. We need to look a little bit more in depth into where the market pricing is coming from. Is it just the growth investments, or is it more broadly based at higher multiple? Again, last comment on this page is about the returns. This is not your portfolio, but the broad private equity market. For the period that we're going to go through for your semi-annual report, there's been an improvement in returns for the trailing 1 year period. 8.7% was the trailing 1 year period through September 30, 2024, versus a figure of 7.3 for the prior year. So here's where we're asked to bring out our crystal ball. What I can say with certainty is not a whole lot, but that the market will continue to increase. Your allocation to private equity has gone up steadily over time. Your peers have allocated more to private equity, and the market is getting bigger. And I think that that will continue. This was written a few weeks ago, so we don't have much here regarding recent turmoil in the markets. We noted that transaction activity was expected to increase in 2025. We still believe that, but our reasons, as noted here, were uncertainty due to the election and geopolitical volatility, contributed to wide bid-ask spreads. That debated for a period of time, but that may be just back where it was a couple months ago. That remains to be seen. Last thing I'll mention here is on venture capital. AI has come up in a number of conversations. It's an area where you do have some direct investments through your venture portfolio, but by and large, right now, the state of affairs is that your buyout managers, which is 3/4 of your private equity portfolio, are not really using AI as a tool to do their job per se, just to make selections, but are really looking at AI as a tool like the internet was back in the .com era, where this is something that everyone is going to use to get more efficient with what they do. The most pronounced use of AI in that sense is for software businesses, where AI is used to create code, and then there it is very much embedded. And that is the part of the market where you see very, very significant and sophisticated use of AI, as opposed to it being used as a tool to make certain processes slightly more efficient at individual companies. One more thing, DeepSeek, this is a little dated. I'll note we put this together a few weeks ago, but DeepSeek was a check really on how we're investing in AI here in the United States and how a lot of pension funds like you are investing in AI. And it had a bit of a chilling effect on the venture industry, because what it showed is that a Chinese company seeking to compete with OpenAI was able to achieve a lot with a little. Very little time, very little capital, and even having a restriction of semiconductors, the chips that are needed to create the AI. And so that had a bit of a chilling effect. Are we deploying capital in a constructive way? And there's been a bit of a disruption and a rethink to how the venture capital industry is deploying capital to pursue AI wins. With that, I'll turn it over to Tad to go through maybe I'll pause for questions here and then turn it over to Tad to go through your semi-annual report.
Yeah, thank you,
Questions for
Mr.
John.
Chair. Question, and it's more general nature, is how you advise our staff to deal with the ongoing issue of past results don't necessarily predict future performance. And so you see all these people who've done so great in the market in the last year, last 2 years, 3 years. At some point, there's going to be a return to the mean, and it's just where do you catch it in that stream? And how do you advise staff to deal with that, to know that somebody has petered out and isn't going to produce those returns in the future versus somebody who's on the upswing? What do you look for?
Well, your staff is very experienced in doing manager selection. And one of the things that I mentioned earlier about re-ups or recommitments and the ratio of investments with existing managers versus new managers is very instructive. If you were to look at your portfolio and see for, say, 2025, that every investment that you have and all your capital deployment was with the same managers that you had before, that might be a cause for evaluation. It's possible that those were the best managers to invest with, only investing in the ones that you've been with in the past. But you have a healthy mix of new blood, new investments with managers that represent new relationships and new strategies. Anytime you're allocating to a new strategy or a new manager, it means that you are displacing a manager with whom you've worked before. And that's a difficult thing to do. It's a very healthy part of the process. We're looking at that, we're talking to your staff about that, and we see ample evidence of those hard decisions being made. One of the biggest things that can happen in a portfolio like yours is the size of the funds that you're committing to are sufficiently large that the old incentive systems that we relied upon of carried interest being what you play for don't really work. You're getting very, very wealthy whether or not you perform. So what's critical, of course, are traditional things like benchmark analysis. Did you perform on a risk-adjusted basis the way we expected you to? That's the core issue. Is the team intact that did that in the past for the future? But also, is the alignment there? Are the incentives there, which have something to do with the size of the fund, something to do with the fee structure of the fund, and a lot of fuzzy things related to people's personal motivation to come to work and work hard for a return. I think your team is looking very carefully at those things.
Thank you. Can I ask one more question? And because you raised it with regard to the carried interest, and if that becomes less of a tax preference, and that these investment managers are going to have to look elsewhere to generate income, is that likely to result in an increase in fees on the front end?
It's possible. I would first say that the likelihood of taxation of carried interest changing in the next 3.5 years is much lower than it was in the last 4 years or the different administrations. So I think that if I were a betting man, I wouldn't expect the taxation of carried interest to change.
Okay, because I'd read differently, but that's great. Just curious.
But if it were, when there was rumbling about it and it became something that seemed imminent or felt imminent to us, there was talk to the LP community that they might make adjustments to other economics of the funds in order to come out whole, which is something that I would flatly reject, and I think your team would flatly reject as well. But there will be that impulse by the industry probably to make themselves whole if the taxation reduces their compensation from prior arrangements.
Okay, thank you.
I would just kind of add, it is already an expensive asset class, and I think it's going to be very challenging for them to pass on that, to make them whole, to pass that on to LPs. So I think there'll be a pretty united pushback on those kind of efforts.
Thank you for that. Thank you, Mr. Chair.
You're welcome, Mr. Morris. So we have Ms. Hendricks and then Ms. Yamamoto.
Steve, I'm glad you raised that because I've heard a different perspective on that as well. So it just kind of underlines, I think, the challenge right now that there's just, you hear so these issues and there's more than even two sides on some of these issues in terms of what people are projecting for the next couple of years. But so unrelated to kind of the current administration, but just thinking about the asset class of private equity, and we've been in this space for quite some time. And what I hear out there, it's a maturing asset class. And so, it used to be we would say, oh, a CalSTRS private equity, we're in this space because it really, the returns are good and it helps us get our 7%. And I think, there's conversations because so many institutional investors are, in this space or moving more in this space like we are, about maybe that not being, as robust of a return for us in the future. And so I wonder if you could talk about, it's a crystal ball question again, because this is what we want to know the future and we can't. But can you talk a little bit about, my understanding is the opportunities might be diluted because there's more asset owners like us in the market. And then I think, it just seems to me the industry of private equity has changed quite a bit. Or not, so you tell me. But as you think about the role that private equity has played for us in maybe the last 10 years, and then as you look at it in the next maybe 5 to 10 years, to my mind, talking to other trustees on other funds, it just seems like there's potential for it to not necessarily perform at the level that it has for us in the past. So can you talk about that a little bit?
Yeah, I think that's likely, and I think that's okay within an asset allocation context. I think what one can focus on is that spread. How much more return from stocks are you going to get out of it? Right now, your benchmark is 150 basis points over a global index. And that historically was a larger number for a lot of institutions. And so that spread in your benchmark reflects some of the increased competition in the space. And when there's more competition, the opportunity for additional return can come down. This is all theoretical.
Mm-hmm.
The countervailing force, though, that's really strong is how much larger this market is. And when people go through an asset allocation exercise, you often consider how big the investable universe is first.
Yeah.
And so I'm betting that allocations will continue to go up in private equity because the stock market on a relative basis will be smaller.
Mm.
The playbook is getting more sophisticated by private equity managers. That's another positive thing, that most managers with whom your team commits have dedicated teams to making companies better. That's a new phenomenon in the last 10 years, where on staff are people that know how to implement enterprise software for the businesses that they own. They have HR specialists. They have people that will collectively price FedEx accounts for all the portfolio companies and try to reduce costs across the board. There's lots of things that are going on that make this a very much more active ownership process, which portends for the skilled practitioners a more chance to create higher returns.
Gotcha. We do business with the higher practitioners in general, I would hope, right?
And other things happen unpredictably through time. There could be a downturn in the stock market where a take private strategy is really appealing, and a lot of your managers are able to take private some companies that have been battered in the stock market. And there are times when doing so-called corporate carve-outs, where you buy a division of General Electric, you pull that out and manage it better. There are cycles where these sorts of strategies really lend themselves well to just the private equity playbook. So, but I think overall, it's smart to expect lower returns on an absolute basis, and also slightly smaller spread to stocks over time, because a lot more people with the same toolbox have arrived to play the same game as your existing managers.
And maybe something that I might add there, just to add a little bit of context from the total portfolio approach, I think it's, a very healthy exercise to reevaluate the role of what private equity would play to your portfolio that's growing more complex and bigger and more sophisticated, right? And to John's point, you're still getting a premium over public markets. And so that still is a healthy case to be made as one of the reasons why you should be in the asset class. One of the other things that we always think about is what are the diversification benefits? You're getting a little bit more of a smoother ride by putting a different return driver in the portfolio. So it's certainly something that we can look at from his perspective, but also when we take a look at the intended role once all these other asset classes are in place as well.
Thanks, Ms. Yamamoto.
Okay, thank you, Mr. Chair. Thank you for the report. I want to go back to that slide that you talked about due diligence, because it's really important to me, and I didn't really realize how big of an issue or a portion of our portfolio that covers. So when you talk about the last part where it says final decision made by investment committee, I remember us at one time being able to look at all the managers and talk about which ones are going to be defunded or continue to be re-upped. What does that mean in this context, in the due diligence process for us, the investment committee, to make that final decision? What final decision are we making? Because I know that we don't choose the managers.
Yes, so the investment committee it's an internal staff investment committee. I think it's 6 senior private market, private equity professionals. So it's not referencing this investment committee. That's an internal staff investment committee that's opining on the individual opportunities.
Okay, so that's the clarity that I missed.
Yeah, sorry, that's
okay.
Should have been
Thank you.
Clarified in the presentation.
Thank you.
Yeah. Just a quick point on governance. The reason we put that bullet in there, it's quite bland and I should have expanded on it a little bit, is that investment processes sometimes can devolve culturally where people defer to one another. That one part of the team, that person does venture and everyone leaves them alone and they can do venture. And this person does software buyout and that person doesn't have to really come back and formally get the approval of colleagues. So there's healthy governance and there's peer review that are part of your process.
Okay. I just didn't see the difference between us and then the actual staff, investment staff. Thank you. Thank you, Mr. Chair.
So on this slide, this is a good slide, 13,000 funds we allocated to 26. I think that's 0.2% of the total investable universe. I think that's right. 0.2%, might be even smaller. I think June is calculating it. I think it's 0.2%. So it's a relatively, what's the dispersion of return? Is that correct, June? Correct. Thank you. So what's the dispersion of returns in private equity?
It's massive. And I think that 13,000 needs a bit of context. Many of them are small and wouldn't necessarily be seen as of institutional quality, but they still need to be screened out in various ways. And some might be too specific a strategy that to be appropriate for, like only investing in AI, for example, so that they're not appropriate for your program.
And if you looked at a private equity manager that we have a relationship with today, that we had a relationship with 10 years ago, do those firms look anything like they did 10 years ago relative to where they're investing, how they're growing, how they're evolving?
They're quite different than they were 10 years ago in a lot of ways. The scale is the one thing. The internal staff to improve investments, be more hands-on. But the size also means that they have a lot of internal staff that they didn't have before. They were a lot more lean with respect to HR and CFO and that sort of thing. Culturally, though, different in that many of them have evolved or devolved, depending on your point of view, to be multi-asset class. Whereas we might have been more inclined to invest with a specialist that only does private equity and furthermore only does value-oriented private equity. Today, a lot of the bigger groups have multiple asset classes, and that makes them more stable businesses, but there remains to be seen whether that's a good thing for all the investors.
One last question, and it's not to diminish in any way or doubt the concerns we hear from external groups who come to our meetings to talk about, in many instances, issues around human capital, treatment of workers, through funds and managers that we might be invested in. Can you, as our consultant, assure us that we should have confidence that our staff engages with our managers prior to making commitments about the importance of human capital, workers, and the importance that we place on those principles of treating workers fairly? It's not to say these instances don't exist, but these are massive organizations with investments all over the place. Do you have a level of confidence that our staff does engage with our managers prior to making commitments about these important issues?
I do. There's a couple reasons why I feel that way. First, we have calls every 2 weeks and discuss these things, but you sent out a questionnaire to your to each manager that you make an investment with, asking about, it's not a litmus test in any way. It's really just discuss your approach to human capital. It's seen as something that is practical to understand. And to the extent that there were issues in the past, it's worth knowing what those issues were with the manager, because issues with labor is not considered widely to be good business. And you know, we have we've had a dialogue about institutions like Ownership Works, which your whole staff is quite familiar with, and I would say that they're quite engaged with that topic and are aware that having a control interest in a company makes things different than investing through stocks.
Okay, thank you. There other there's more to the presentation. Is that correct?
Correct. The next section is we actually dive into the CalSTRS specific private equity performance, and I can kind of be relatively succinct with my comments, but John's flipped to the right page here. So overall, performance continues to be strong in the private equity program, as highlighted in the aggregate results in the top line of this chart. Consistent double-digit returns across the periods evaluated, except the latest 3-year period, which dipped into the single digit. As we've kind of highlighted, it's been a more challenging environment with slower transactions, kind of muted valuations. But the key metric I like to point out is the performance relative to the custom State Street Index. This is the private equity based benchmark, so kind of comparing results relative to the current opportunity set. And you can see outperformance relative to the 1, 3, 5, and 10-year periods. So really highlighting that the current portfolio construction and manager selection is resulting in outperformance relative to the private equity oriented index. The second benchmark is the custom benchmark, and this is the public equity plus a premium benchmark that's been referenced. And I view this as an opportunity cost measure. Where could this capital have been? And it's intended to be measured over longer time periods of 10 years or more. And looking at this, the program has outperformed this benchmark by 1.7% over the 10-year period. We showed the shorter periods just for consistency, but highlighting that significant underperformance over the 1-year period. And this has been mentioned several times this morning already, where a strong public equity index, the private equity valuations will be incorporated on a lagged basis, so they don't capture the upside as quickly. And that's really highlighted in that 1-year period of underperforming out by almost 23%. And this is consistent across any institutional investor that has a public equity benchmark over the latest 1-year period. So there's no concerns on that front. On the next slide, we peel back the onion a little bit more and look at performance by strategy. And buyouts represents the vast majority there. The program, over 3/4 of the net asset value. And overall strong relative and absolute performance. There again, a little bit of underperformance over the 3-year period, but no concerns there. So more muted and mixed results relative to the smaller exposures in venture capital, debt related, and special mandates. We've discussed previously the challenge of deploying material amounts of capital to the venture capital space, particularly the early stage venture capital. But overall, you're getting a little bit more late stage, and there has been some evolution of the construct to gain more exposure to the early stage. But overall results have been attractive on an absolute basis over the longer term, and we think appropriate overall results. And then there's more kind of benchmark mismatch for the debt related and special mandates, but no material concerns in those red arrows in the sector strategies. So on the next slide here, we look at the performance of the funds relative to co-investments. And as we mentioned, this is the primary area where the collaborative model is implemented within the private equity asset class. And the co-investments are conducted on no fee, no management, no management fee, no carried interest, and overall performing very well and performing in line with expectations. The exposure to co-investments has increased. It's up to almost 22.5%. But just looking at the 10-year number, the co-investments have outperformed by 3.1% per year over that 10-year period. So generating the results that we'd like to see for the collaborative model. On the next slide, we take a little bit closer look at the geographic exposures. Here, overall, I'd say, positive contributions on both an absolute and relative periods, depending on what time period you look at. North America is the largest proportion of the overall portfolio, up to around 3/4 of the portfolio, so it is a domestically oriented portfolio. But here, depending on the time period, you may see outperformance of the non-US type exposures, but this just indicates the diversification of the geographies have been added over time within the portfolio. On the next slide, a little bit more on the implementation of the program. These blue bars represent the vintage year exposures within the portfolio. And so we really strive to maintain vintage year diversification over time. And this is based on the definition of the underlying partnership, but not when the actual investment decision was made. And so there's a little bit more variability in the actual bar charts than has been, as staff has approved investments. For example, in 2020, I think there's several opportunities that were improved in 2020 that rolled into the 2021 vintage. So that's exaggerating that number. But overall, the staff has consistently achieved their pacing targets on a more measured basis. And it's not quite to the volatility that you see here. But just want to note that the annual pacing targets have been reflective of the overall status of the portfolio and market dynamics. And as you see the decline in 2022 and 23, that's representing a slower environment. Staff has been more selective in how they're deploying that capital. We've used that word throughout the day of selective, partnership selection. And 2024 has, exhibited a slight uptick, and we expect 2025 to be additional increase from there. But this has been a period of high selectivity, raising the bar that was mentioned earlier. But overall, there's been a consistent and thoughtful deployment and maintaining vintage year diversification within the program. And the next slide, we just have the key policy parameters. The program in aggregate represents 15.7% of the total portfolio. This is a little bit over the target of 14%. As we mentioned, there's been illiquidity in the private equity markets, so there's a little bit of stagnant NAV that's been held up into there, but well within the overall total portfolio allocation. And the subsectors are in line with their target parameters. So overall within policy and compliant with the stated targets. Then I pass it back to John for final comments.
Before I do that, I want to make note of the category of longer term strategy, because I think it dovetails with what Ms. Hendricks had said earlier or at her question. This is a strategy that hasn't really grown much. It's only 2% of the interim target, but it could be a sign of what might be to come for the asset class. It is a type of strategy that is more core. Core across all asset classes means less risk, less potential return. So far, these strategies have returned just as well as the rest of the portfolio, but they're offered more on a cheaper basis. They're investing in larger companies, and they're intended to be a little bit less volatile than traditional private equity. So that's a place to look. That might be a sign of things to come, but by no means is your portfolio anything like an index fund. There's very active choices that are made in your portfolio, and you don't represent the rest of the market in any way. I'll leave it at that. The summary includes all things that we've mentioned already.
Questions, comments? Okay, thank you, Stephanie. Thank you, John. Thank you, Ted.
Thank you.
Were there any public comments for items 5A, B, or C?
There are no members of the public in the queue.
Thank you. Item 6 is the consent, and I think Ms. Yamamoto has some questions or clarification for 6.
I know that, thank you, Mr. Chair. I know that last time in January, there was kind of a weird setup, the weird conversations that we had as far as virtual versus in person. And so I didn't know how we should note those in the minutes because some of the members were virtually, some of them were in person. And so that's what I just wanted to make sure that we knew how they were going to be listed. And I asked council about it, and I think we were still going to decide on how that was going to be done. And then also at the end, Denise Bradford was the chair of that committee during that time. So to sign off appropriately.
Thank you, and I appreciate, you're really paying close attention and your insight to this, and we are taking a look at how to accurately reflect it. Normally we reflect board members going on and off the dais, at least for an extended period of time. So I think we want to reflect it that way as well. So the public reading the minutes know exactly how and when the board members are participating, even if they're not making comment or even if they're listening as opposed to participating. For example, if they're observers, I think we need to capture that. So we have like 12 lawyers working on it. We'll come up with something.
Okay, thank you. Thank you.
How many lawyers does it take? Right.
Yeah, that was a joke, by the way.
So let me just, are we comfortable approving the minutes with this, or are we going to bring them back?
Either way, we have very specific comments from Ms. Yamamoto, but I'm comfortable either way.
Yeah, can we approve with the edits?
Approve
Can
with
we
the
with the
edits?
prospective edits?
Okay, yeah, sure.
And I'll report back what those were.
Thank you.
Thank you.
Alex, any information requests?
The one I had was with respect to the real estate asset class implementing the independent fiduciary, and to report, to discuss with staff and report back to you and Vice Chair Bradford before bringing it back to that consideration back to the full committee.
Yeah, right, before it comes back to the floor.
Correct.
Yeah, perfect, Alex, thank you.
Yep.
Yeah. We can discuss pros and cons, yeah. Okay, Scott, anything you want to highlight for the draft agenda for our next meeting?
Yeah, I think it's going to be hard to pick the big three. May is a big investment committee. I point out a couple items. One, we've got the annual updates of two of the branch's priorities. One is the path to net zero. The other is the diversity in the investment management, DIMI. The second is the shared vision. So we have more of the reviews and assessments coming up. One is in investment services, our operations, another in technology, and then our SIS division with the potential policy change. I would also point you to an update on our strategic asset allocation, the interim steps we'll be bringing forward as well. So it's going to be a powerful May coming up.
Yeah, thanks, Scott. Before we break for lunch, talk a little bit about the logistics in closed session. I'll defer to you, Scott, to just talk a little bit about our logistics for closed session this afternoon.
Oh, sure, great. So we're going to, for item 9, which is the closed session semi-annual performance reports presented by your consultants, there'll be two segments. One is a segment where each of the general consultant, the real estate consultant, and our private equity consultant will talk about our specific transactions. Then we're going to reserve 20 minutes at the end of it. We're going to break to the caucus room because there have been a number of questions on items spanning from corporate governance, on issues such as Tesla and other elements, which we want to take in a smaller discussion, as well as questions around private credit and our asset-backed strategy. So we will break and move to the caucus room at the end of the item 9. I point your attention as well to item 13. We'll also break to the caucus room during that closed session item as well to discuss certain items, considerations around things like our tax status, et cetera.
Great. All right, so Samantha, are there any public comments?
There are no members of the public in the queue.
Thanks, Samantha. So with that, we are going to break for lunch and we'll reconvene at 1:30 in closed session.
Oh, I see.